assessment 2021 and 2022 have the option to claim over 1 year. Okay, so today we will be going through capital allowance, basis of taxation, ascertain the assessable income, and relief of double taxation on foreign income. We'll take a short break after the basis of taxation, and today's lesson will be lesser of the poll. We will spend more time on the case study 2, where is the computation of tax computation of a trading company. Okay, any questions so far? If not, I proceed to capital allowance. Okay, the Singapore Income Tax Act does not provide a definition. Okay, capital allowance is actually claimed on plant and machinery. So the Singapore Income Tax Act doesn't provide a definition on what is plant and machinery, and such word must be given in their ordinary meaning. We can also seek guidance from case law on the meaning of plant and machinery. Okay, so a plant and machinery includes whatever apparatus that is used by the businessman for carrying on his business, which he kept for permanent employment of his business. A basic characteristic of a machinery is that it has moving parts. It's like items like cranes, computer, motor vehicles, equipments. For plant, it is an apparatus which which a person carries on a trade, business, or profession. So we get guidance from case law on the characteristic of a plant. So a plant is unlikely to be an item that is stock in trade, and we have to look at the plant, the function that it performs in context with the trade in question. And also we have to consider whether this plant is used in the business settings or used in the business operations. So some principles to consider whether a plant is qualified as some principles to consider whether the assets qualify as a plant. We can look at whether it's durable, whether it is used for the place or settings, and we have to look at the function of the plant that is used in the trade or businesses. And also we look at the operation function of a building or structure. Later we'll take a look at ZF versus CIT case on what is considered as a plant for a building or structure. And also we can consider as decoration. If let's say the decoration is used to create atmosphere for certain trades like hotels, it can be considered as plant. So general electrical installation is not considered a plant and cannot claim capital allowance, but we can claim under renovation and refurbishment expenses. So if let's say the electrician installation is for specific purpose, like to install a machine, it can be considered as plant. Okay, so in this ZF versus CIT, it considered that portable and demountable prefabric dormitories are considered as plant. So dormitories are usually regarded as building or structure, right? But in this case, it was regarded as plant. And some of the consideration by the court is actually what is the exact operational role of this asset in the taxpayer business, and the physical nature and characteristic of the assets, the intention in use and location of the assets, and whether the assets form part of the business of the building. So the purpose of the business is to provide accommodation on a temporary basis. So the commercial dormitories is regarded as plant in this nature. There are some examples on items that can be considered as plant. You can read through these examples. These are mainly the common ones. Okay, so for capital allowance, where a person is carrying on a trade, business, profession, or vocation and incurred capital expenditure on provision of plant and machinery for that trade, business, profession, or profession, he will be given on due claim capital allowance under Section 19 or 19A. So Section 22 extend the meaning of capital expenditure on the provision of machinery to include capital expenditure on alteration to existing building incidental to the installation of machine, plant for the purpose of trade, business, profession, vocation. So expenses, delivery costs, installation costs, removal and reinstallation costs are part of the qualifying expenditure, but financing costs to acquire the plant and machinery is excluded. Cannot claim capital allowance of financing costs. So capital allowance is governed under Section 19 or 19A. Under Section 19, the capital allowance claim is over the prescribed working life of an asset. It includes two components. One is initial allowance and annual allowance, and the other is annual allowance. So annual allowance is claimed over the prescribed working life of the assets. And the prescribed working life of the assets can be found in the 6th schedule of the Income Tax Act. It can be claimed either over 6 years, 12 years, or 16 years for assets that is acquired in or after year assessment 2023. So under Section 19A is the accelerated capital allowance. So accelerated capital allowance are capital allowance claiming over a shorter period of time. It can be over 3 years, 2 years, or 1 year. Okay, the more common one is 3 years. The 2 years were provided under certain for only certain year assessment. We take a look at the capital allowance in greater detail in the next few slides. Under Section 19A, there is the accelerated capital allowance claim. The allowance is claimed over a period of 3 years. That means the capital expenditure is deducted, divided by 3, and each year you will claim 1/3 of the qualifying expenditure. It is on due claim. The assets need not be in use at the end of the basis period. It can be deferred and claimed in future years as long as the asset is not permanently ceased to be in use in the trade. Okay, this is the example that shows capital allowance claim over 3 years and can be deferred as long as the company has not disposed or write off the assets. So we have cost of equipment of 75,000. If we make a claim under Section 19A, which is over a period of 3 years, we will claim 1/3 of the capital expenditure of 75,000 in year assessment 2021. Thereafter, we have a tax return down value of 50 using 75,000 minus 25,000. Okay, in year assessment, if the company decided not to claim capital allowance for this cost of equipment because the company may have experiencing some losses, okay, they can defer. So in year assessment 2022, there is no claim of no capital allowance claim for the cost of equipment. So the tax return down value remains at 50. Okay, in year assessment 2023, the company continued to claim capital allowance, claiming 1/3 of the 75,000, which is 25,000. And the tax return down value as at 31st December 2022 is 25,000. Okay. So tax return down value is actually equals to the capital expenditure incurred less the capital allowance already given. Okay. It's actually the capital expenditure on which capital allowance have not been granted. So under section 19A, we also 1E, we have an allowance of 2 years write-off for year assessment 2021 and 2022. Okay, this 2021 and 2022 is the special year where capital allowance can be claimed on the capital expenditure acquired in YA 2021 and YA 2022. In the first year where the assets was acquired, it will be claimed under 75%, and the subsequent year will be claimed 25%, the remaining 25%. So for this capital expenditure that claim over 2 years, again, is on due claim, and there must be an election made for this claim. Okay, so this claim cannot be deferred. So once they claim 75% in the first year, they need to claim 25% in the following year. There's no deferment of capital allowance. Okay, so similarly as section 19A1, the plant do not need to be, machinery do not need to be in use at the end of the basis period. Under the accelerated capital allowance, we have also 1 year write-off. Under this 1 year write-off is under section 19A2, which means in a particular year, the company can claim an annual allowance of 100% of the qualifying expenditure. Again, it is on due claim. And what are the plant and machinery that can be claimed is actually computers and prescribed automation equipment. What are the prescribed automation equipment can be found in the Income Tax Act, Automation Equipment Rules 2004 and Amendment Rules 2010. So examples of assets that can claim, qualifying expenditure that can claim under section 19A2 will be computers, printer, scanner, data communication, and software used for automation equipment. Okay, so for this kind of qualifying expenditure, we can claim over 1 year. Okay, so usually it's 3 years or 1 year. Okay, but only for year assessment 2021 and 2022, there is a 75 and 25% claim if the company elected for it. Okay, under section 19A, 10A, we have also accelerated claim on low value assets. So for assets qualifying expenditure that has, for each asset that doesn't cost more than 5,000, the company can claim over 1 year. But the total claim for such asset is capped at 30,000. Okay, which means if let's say the company has more than 30,000, only 30,000 of the assets can be claimed over a period of 1 year. The remaining will claim over 3 years. So section 19A, 10A example, a company purchased table and chairs for 45,000 in the year assessment 2023. Each table and chair cost less than 5,000. So under section 10A, 19A, 10A, we can claim the tables and chairs over a period of 1 year, but up to a cap of 30,000. So what happens to the remaining 15,000? Because it is acquired in year assessment 2023, the 15,000 can be claimed over a period of 3 years. So 1/3 of the qualifying expenditure of 15,000 can be claimed, which is 5,000. So we can claim 45,000 out of the 45,000, we can claim 30,000. and 5,000, and the tax return down value is 10,000. Okay, let's go through an example on Section 19A Accelerated CA. Okay, for example, if let's say the equipment is purchased in year assessment 2020, but no CA claim, CA is claimed from YA 2021. Okay, so we have a list of assets here. We have equipment that has a cost of 75,000. Okay, it says that it purchased in the year assessment 2020, but it's not claiming, so that's a deferment of the capital allowance claim in 2020. So it starts to claim in 2021, which is 1/3 of the cost of 75,000. That is 25,000, 25,000, and 25,000 over the next 3 years. Then they have this computer that costs 5,500. It is qualifying to claim under Section 19A2 the full amount, the 100% in the year it acquired, that is YA 2021. They also have furnitures that cost total cost is 30,000, but the cost of each item is not more than 5,000. So we will claim under Section 19A, 10A, 30,000, 100%. The company also acquire machine under Section 10,000 under Section 19A 1E, because the assets is acquired in YA 2021. They have an option to choose whether they want to claim over a 2 years period. So in the first year, it will claim 75%, that is 7,500, and the following year, it will claim 25%, which is 2,500. Next, we have the movable partition. Movable partition, again, it is acquired or incurred in year assessment 2021, and there's an election to claim over 2 years, so 75% in year assessment 2022 and 75% in year assessment 2022 and 25% in year assessment 2023. Let me pause here and see whether you have any question. Okay, I'm looking at the chat. For the capital allowance claim under the 3 years, that is Section 19A1, it need not be consecutive. So the company can claim the first year and defer in the second year and continue to claim the third year and defer again, so long as the assets is still in use in the company and it's not permanently seized. That means you don't write off the assets or don't dispose the asset, you can continue to claim. Okay. Jean, you have a question that says example skip YA 2022. So it can claim in YA 2024. Which example are you referring to?
Sorry, you answered the question already. It's relating to the whether it can be consecutive or not. Yeah.
Okay, all right. Okay,
Thanks.
Okay, Section 19A, there's no cap on Section 19A2. Okay, so they are relating to computers, prescribed automation equipment that can claim under Section 19A2. There's no cap on the amount of the capital allowance. The cap is only on Section 19A, 10A, those low value assets. Okay, so capital allowance item that can cost huge sum of money, like millions of dollars. It could be some prescribed automation equipment, millions of dollars. I have not really. It could be those big software, you know, those ERP system and things like that. I'm not sure whether it is millions of dollars lah. Okay, Jean, to answer to your question.
Oh, thank you.
Okay. So any other question for Section 19A Accelerated CA before I move on? Okay, if not, let's move to assets acquired under hire purchase. So for assets that is acquired under hire purchase, there's two components. One is capital repayment and one is hire purchase interest. In the earlier slide, we mentioned that financing costs to acquire the assets is not qualifying for capital allowance claim, but it is deductible under Section 14(1)(a), okay, the HP interest. For capital repayment, that is the cost of the assets, okay, that is paid over a period of time. This capital repayment can be claimed under Section 19 or Section 19A. Okay, so if let's say, again, if the assets is acquired in year assessment 2021 or 2022, the company can make an election to claim the capital expenditure incurred over a period of 2 years. And the first year will be 75%, and the subsequent year, the following year will be 25%. So an example on hire purchase assets. A fast food restaurant, which has an accounting year end of 31st December, bought a new piece of electrical machinery on 1st July 2022 on hire purchase terms. The agreement shows that cash purchase of the machinery is 75,000 and the interest is 60,000. The total sum payable is 81,000. Okay, upon the initial delivery of the electrical equipment to the fast food restaurant, the fast food restaurant pay $9,000, and the rest is by hire purchase installment. Okay, so there is a 12 months payment of 6,000 on the last day of each month, and the first payment is made on the 31st of July. Okay, so this payment of 6,000 actually includes the capital repayment component as well as the hire purchase interest, right? So if let's say we have a 6,000 over a period of 12 months, it will be 72,000, and total you will get 81,000. We want to compute the capital allowance due under Section 19A for year assessment 2023. So again, the cash price of the machinery is 75,000. You have an initial payment of 9,000 and a 6 months payment from 1st July onwards to December 2022. 6 months times 6,000, you get 36,000. So the total amount paid by the fast food restaurant is 45,000 in the year 2022. Okay, so this 45,000 includes the hire purchase interest. We need to less out the hire purchase interest. So 6 months over 12 months, they paid a total of hire purchase interest of 6,000 over a period of 12 months, right? So for the year 2020, they only pay 6 months. So 6 over 12 times 6,000, you get 3,000. So if I less 3,000 from 45,000, my capital expenditure is actually 42,000. So this is the capital repayment of just the capital, excluding the interest. Okay, so this is the capital expenditure that I paid out of the 75,000. Okay, for the year assessment 2023, the company can claim annual allowance under Section 19A(1) of 42,000 divided by 3. That means 1/3 of what the company has paid. Okay, 14,000. Then the remaining written down value as at 31st December 2022 is 61,000. 61,000 is using the cash price of 75,000 less the 14,000 CA that is claimed to arrive at the tax return down value. Okay, we also have capital allowance for motor vehicles. Similarly to deduction, private car expenses, private car acquisition or private car cannot be claimed, no capital allowance can be claimed. So company cars and cube-related cars are also not allowed to claim capital allowance. Taxis and car registered as private hire or cars for instructional purpose are hired out or used for providing driving instruction in the course of the company's business. Vans, lorry, motorcycle acquired for business use, motor vehicle registered and used outside Singapore is qualifying for capital allowance claim under Section 19A or 19. So again, we look at how do we make adjustment to the tax computation for plant and machinery. So plant and machinery usually are fixed assets. They are capitalized in the balance sheet. So once it is capitalized in the balance sheet, there's no need to make any adjustment to add back the cost of the assets, right? So we will just claim the capital allowance amount against the, we'll just deduct the capital allowance from the net profit before tax. Okay, but then we have to consider, okay, even if the company does not, even if the company has capitalized the capital allowance, right, there's this component called depreciation that is included in the profit and loss. So depreciation is not deductible under Section 14(1). So we will add back the depreciation. Okay, so for capital expenditure that is reflected in the profit and loss, for example, some of the small item fixed assets has been write off or in the profit and loss. Okay, so this kind of capital expenditure, we will add back the amount. Then we will give them back the capital allowance amount. Okay, so for example, there's some small value assets, some maybe smartphone or tables and chairs, you know. The accountant, instead of recording it in the balance sheet, has recorded it in the P&L. So the cost of these tables and chairs and compute or smartphones, we have to add back the entire amount. Then we will give the capital allowance claim under the capital allowance section. Okay. Balancing adjustment. Balancing adjustment is computed when the company dispose or permanently cease to use the asset. That means they have write off the assets. Okay, so the capital allowance, balancing allowance is computed based on the, okay, I move to the next slide. Yeah. So balancing adjustment, there's two types of balancing adjustment. One is balancing allowance and one is balancing charge. So balancing adjustment is actually the sales proceed minus the tax return down value. Okay, if the tax return down value, that means the cost of the assets for which the CA has not been claimed is more than the sales proceed, then the difference will be the balancing allowance. If the tax return down value is less than the sales proceed, then the difference is the balancing charge. So for balancing charge, we only tax the balancing charge up to the amount of capital allowance that was previously claimed. So if let's say the sales proceed is more, right, we will look at how much capital allowance have been claimed in the prior years. Okay, and we only tax up to that amount for balancing charge. Okay, let's take a look at example. So company purchased the equipment costing 75,000 on 1st March 2021. On 30th June 2022, it sold the equipment for 40,000. Okay, so the cost of equipment is 75,000, and in the year of assessment 2022, the company claimed 25,000, 1/3 of the qualifying cost. And they have a tax return down value of 50,000. So they sold the asset for 40,000. And 40,000, the sales proceed is less than the tax return down value of 50,000. We come up with a balancing allowance of 10,000. Okay, so how much capital allowance actually allowed? It's actually 25,000 and 10,000. Okay, altogether it is 35,000. And this 35,000 actually matches to you use the cost of equipment less the sales proceed of 40,000 is also 35,000. So essentially it means that the capital allowance claim will be given only to the net amount, right? You use the cost less the sales proceed. Okay, this is the way for you to check whether your balancing allowance is correct. Another example, for this slide, can you change your slide notes to 80,000 and 80,000 here? Okay, so for example 2, company purchased an equipment cost of 75,000 on 1st March 2018, and on 30th June 2022, it sold the equipment for 80,000. Okay, so instead of the earlier 40,000, now increased to 80,000, right? So again, the company claimed the cost of equipment. There's a cost of equipment, and they claim the capital allowance over a 3 years period. So as at 31st December 2021, the tax return down value is actually 0. Okay, comparing to the sales proceed of 80,000, sales proceed more than the tax return down value, so it is a balancing charge. Okay, so balancing charge of how much? The CLCA claim is 75,000. So balancing charge will be 75,000. So this amount of 75,000 is taxable. So effectively, if I allow the 75,000 over the CA claim in the previous year, and the company got taxed back at 75,000, essentially the company zeroized the capital allowance claim because the sales proceed is higher than the cost of equipment. So again, balancing allowance is deductible and balancing charge is taxable but capped to the amount of capital allowances previously claimed. Okay, sales between related persons. So there will be circumstances where there's a group of company that own an asset and they decided that they are no longer using this, company A is no longer using this asset and decided to transfer to company B. Both company A and company B are related. Okay, so they can elect for section 24, where under section 24, it will be as if that there is no sales transaction exists between the two related persons. So if company A were to sell the assets to company B, that is the buyer, okay, company A will not need to compute any balancing allowance or balancing charge if it makes the election under section 24. And on the buyer side, it can continue to claim the capital allowance based on the tax return down value transferred from company A. So if let's say company A has claimed accelerated allowance on the machinery, okay, of 75,000, maybe they claim 1/3, only 25,000. Then buyer with the company B will continue to claim the remaining 50,000 over a period of 2 years. Okay. Any questions? Okay, if not, then we move on. Okay, so these are some supplementary slides on case law relating to plant and machinery, as well as some slides on section 19 hire purchase computation is for your reading. Okay, I want to move on to basis of taxation. Okay. Okay, for basis of taxation, last Saturday we covered capital versus revenue divide, right? Capital receipts is not taxable and revenue receipt is taxable. Then we have section 10 that provides a list of income that is subject to tax. So when is this income subject to tax? Okay, Singapore adopts a modified territorial basis of taxation. That means that tax is levied on Singapore source income on an accruing or derived from Singapore basis and on foreign source income that is received in Singapore from outside Singapore. So under the income, it is further divided into two. One Singapore source and one foreign source. Singapore source will be taxed on accruing and derived from Singapore accruing basis, or foreign source income will be taxed on receiving basis upon receipt. So section 10(1) income could either be a Singapore source income or foreign source income. For example, trade income, interest income, dividend income, rental income. We need to consider that whether these income are Singapore source or foreign source. If these income are Singapore source, they are taxed on accruing basis. However, if these income are foreign source, they are taxed on receiving basis. In other words, if foreign source income is not received in Singapore, it is not subject to tax in Singapore. So under what circumstances is foreign source income regarded as received in Singapore? We will look at section 1025 on when the income is considered as received or deemed received in Singapore. I will elaborate more on the income regarded as Singapore or foreign source income and deemed remittance rule in the later slide. So besides section 10, we have the income tax provision has also a deemed income provision under section 12, for which deemed income is subject to tax on accruing basis. So under source rule, again, the Income Tax Act does not define what is Singapore source and what is foreign source. So generally, trade income will be considered as, we will look at where the business is conducted to determine whether it is Singapore source or foreign source. Employment income is where the employment is exercised, and rental income is where the property is located. There's no one universal rule for determination of the source. It actually depends on the facts of the case and circumstances. Okay, so looking at the trade, where is the trade income sourced? We can adopt the operational test to ascertain where the business is conducted and whether trade income is sourced in Singapore. In the operational test, we will look at the entire operation of the trade or business to consider whether it is the income derived is Singapore source or foreign source. We can look at the place where the contract are made, the place where operations to fulfill the contract requirements are conducted, the place where the title of the goods passes, and the place where proceeds are collected or invoice raised. So we look at the entire operation. We do not look at just one segment on where the income, at one section on, for example, services where the particular service is performed. Okay, we consider the entire businesses. Okay, Section 12 contains provision that deem income to be derived from Singapore under specific circumstances. So these are not actual receipts, but deemed receipts, okay? For example, interest paid to a non-resident. Okay, tax on such deemed income is collected through withholding tax mechanism if, let's say, the income recipient does not carry on a trade in Singapore. So this will be covered in greater detail in your withholding tax costs. In the earlier slides, I said that foreign source income is taxed on upon receipt in Singapore. Okay, so when the foreign source income is considered as received in Singapore or deemed received in Singapore, we look at the deemed remittance provision in Section 1025. A foreign source income will be deemed to be received in Singapore when the foreign source income is remitted, transmitted, or brought into Singapore, or when the foreign source income is used to settle any trade debt incurred in respect of the trade of businesses, and when the foreign source income is used to purchase any movable property into Singapore. So the first rule is remit, transmit, or brought into Singapore. So if, let's say, the overseas debtors have paid you, or the interest income is actually, the overseas interest income is actually received in Singapore through the bank, it is considered as remitted, transmitted, or brought into Singapore. If, let's say, the overseas, the foreign source interest income is used to settle any trade debt will be debt that is under Section 10(1)(a). Okay, so for example, the interest income, foreign interest income is used to pay your overseas supplier. Okay, even though the interest income has never been remitted into Singapore, okay, it is used to pay the overseas supplier for your trade. Okay, this interest income is considered as remitted into Singapore. And or when the foreign source interest income is used to purchase any movable property that is brought into Singapore. Okay, for example, maybe they purchase some stocks or some stocks in trade, okay, that is brought into Singapore. These are movable property. So even though the actual foreign source interest income is not remitted, but it is used to purchase all these movable property that is brought into Singapore, is considered as deemed, the foreign source interest income is actually considered as deemed received in Singapore. IRAS has provided clarification that foreign source under two circumstances that foreign source income is not subject to tax. First is foreign source income remitted into Singapore by non-resident individual or foreign businesses not operating in or from Singapore. And second, foreign source income that is reinvested overseas without remitting into Singapore. So for example, if let's say there is a foreign source interest income, again, instead of remitting into Singapore, it is used to reinvest or acquire, buy an immovable property, or it is used to buy, invest in other stocks that is not brought into Singapore, then they are not considered as remitting into Singapore at the point of reinvestment. Okay. Tax residence. A company can be a tax resident or non-tax resident in Singapore. A company can be a tax resident in Singapore if the control and management of the business is exercised in Singapore. The control and management is in Singapore if the board of directors exercise their power and authority on strategic policy and decision in Singapore. Okay, so generally, both resident and non-resident company operating in Singapore have the same tax obligation and income is subject to the same tax rate. However, a company that is tax resident in Singapore can declare a Singapore dividend income that is a one-tier exempt dividend income, and they can enjoy certain tax incentive. They can also claim double taxation relief under the tax treaty or claim a unilateral tax credit. They can also enjoy certain exemption on foreign dividend, branch profits, and service income received in Singapore under Section 13(8), or they can enjoy the full tax exemption for newly incorporated companies. I pause here for questions. Do you have any questions?
Can I ask a question about a lot of companies they use Singapore to have their holding company, but maybe the operating company is in Vietnam, Indonesia. Maybe they don't meet the control and management requirement, so they still have to file tax in Singapore, right? But they just cannot do all these claims, is it?
How many companies are we talking here?
Let's say
It
one holding company holds something in Indonesia or Vietnam.
holds another company in Indonesia or Vietnam.
Yeah.
So are we looking at the holding company in Singapore, or are we looking at the company in Vietnam?
What's the difference?
Okay, so if let's say this company A is a holding company and it holds another company called company B in Vietnam, right? So this company B in Vietnam is a subsidiary of this company A. Okay, they are both separate legal entity. Okay, so when we are doing the tax, right? The Vietnam is a company, right? A company in Vietnam. So they are separate legal entities. So we are not looking at the Vietnam. We are looking at the company A that is a holding company in Singapore.
Yeah.
So the holding company in Singapore will look at where is the control and management of this holding company. So if this the board of directors exercise the power and authority of this holding company in Singapore, then this holding company in Singapore is considered as a tax resident in Singapore.
Can I know when you know this concept of consolidated accounts, right? So do they file the tax return based on consolidated accounts or entity account?
Okay, so the consolidated account is a requirement under the APRA, and when the company compute the tax, because all the companies or entities are separate legal entities, they will compute the tax based on the entity level.
Okay. Thank you.
Okay. Is there any other questions? Okay, if not, I will move on to ascertain.
Sorry, maybe
Yeah.
can I ask, right? Is it possible to have like a subsidiary company in another country, but the management control is in Singapore?
It is possible. So in another country, they will have another because the country is in another country. So another country will have a different way of determining the tax residence of that company located in that country. So other jurisdiction may also look into like where the company is incorporated. But for Singapore, we look at the control and management of that company. So if it is located in other country, then it's for the other country to determine the tax residence of the company in that country.
But if the management control is in Singapore, so we don't have to consider that in a sense. But it's because like if let's say the company is in Singapore, then we will look into the management control. Is that what you mean?
Okay, so in Singapore, we look at the Singapore company, right? Then we determine whether the Singapore company is a tax resident or not tax resident based on the contract management. But if let's say, for example, just now we mentioned about Vietnam, right? Then Vietnam will have a separate way of looking at the tax resident because that company is located in Vietnam. So they will definitely file the tax return in Vietnam. Yeah, so then they will look at the Vietnam rules on how they determine the tax residence, and certain tax residents will have certain benefits. So the way that they compute will be look at the Vietnam tax law instead of Singapore tax law.
Okay, thank you.
Okay.
Yeah. Hi. Regarding the control, there are foreigner who set up companies in Singapore, and they do nothing. But they have subsidiaries overseas. How do you prove that the control is in Singapore?
Okay, so where they exercise, for example, in the case where you say that they do nothing and they have subsidiary, it seems like they are a holding company.
Yes,
Okay, they
and
are
most
not
of the
a
director might be foreigner. They don't fly into Singapore.
okay. So I think ACRA will have uh, certain rules in place that the directors must be in Singapore, one of the directors must be in Singapore. And then for this company that do nothing, they are actually in the business of holding other businesses, right? So they
Yes.
are investment holding company. That's their principal activity. And how do they decide on some strategic decision on those company that they hold? Okay. And when the directors exercise their powers, where do they hold their board of directors meeting?
Uh,
So if let's say they
I
hold
mean,
their
typically now is online.
So I think there is certain rules on the online. I think you can look up at IRA's website. There are certain rules on when it is considered as Singapore source and when it's considered as foreign source.
Mm.
Yeah, sorry,
Okay.
tax resident in Singapore and tax residents overseas.
Okay.
So we look at where the board of directors meeting are held.
So IRAS will reference to ACRA lah, on
Mm,
this.
ACRA has a set of company laws, company rules on the company need to file their general meeting and things like that. But IRAS will be different is in the sense that IRAS look at the tax return,
Okay.
but ACRA look at the financial
Okay.
statements.
Thank you.
Yeah. Okay.
Can we discuss a little
Yes.
bit further? Since it's an investment holding company, whether you really have control of management in Singapore or not, actually the impact to the shareholders is really about dividend only, right? How IRAS will treat the dividend.
Yeah, so for investment holding company, I think in the earlier slide, under the supplementary slide, it will be about how they will have dividend income. So investment holding company may just hold other subsidiary to get dividend, and it can be having deposits to receive interest income, or you can invest in movable property, in immovable property to receive rental income. So then we'll look at all the sources of income, and we look at the direct expenses, the statutory expenses, and the indirect expenses to compute the tax return.
So if it is not considered a resident of Singapore, but it still has to file with IRAS, how do you tax them?
So it's the same if it is a resident and non-resident. Just now we mentioned that for resident and non-resident, practically they have the same tax obligation, and they are subject to the same tax rate. Just that they will then they will declare Singapore dividend income or not, and then they will enjoy if let's say they receive foreign source income, then will this foreign source income can they claim foreign
Okay.
tax credit?
Okay, yeah. Thanks.
Okay, you're welcome.
Hi Rebecca, can I
Yes.
ask, right, what is the maximum, like, what is the cap for the total CA that can be claimed by a company for every YA?
Okay, there's no total cap that the company can claim, as long as you have incurred the expenditure on qualifying assets, you can claim. The only thing that is capped is only on the 30,000 under Section 19A 10A on those low value assets, but each assets must be less than 5,000, and you can claim a max of 30,000. So we just want to cap that, that you claim, because rightfully all these assets is under Section 19A 1 that is
correct.
over 3 years. But to incentivize, like in the sense that you get to claim over 1 year. But if you get to claim over 1 year, there's a cap of 30,000.
Okay, thank you.
You're welcome. If there's no more questions, we move to ascertain accessible income. Yeah, let me see. Okay, can we touch a little bit more on accessible income before we go for a break? We will stop. We'll stop before donation. Okay. Okay, so statutory income refers to the total income from all sources that is chargeable to tax, including income received in Singapore from outside Singapore. So including foreign source income, right? That's chargeable to tax in Singapore. So there will be income from trade, business, professional vocation, employment income, or interest income, or dividend income, rental income, etc. after deducting the deductible expenses and capital allowance, CA in short. Okay, CA consists of two. One is unabsorbed CA. Okay, we call it UCA, and the current year CA. So if you look at slide 9, right, there is a tax computation format. Okay, there is a statutory income. It includes the adjusted profit, less unabsorbed CA and current year CA. Then they will plus all sources of income, all passive source income, all sources of other sources of income as well. Okay, so UCA is the CA that is not utilized in the prior years and brought forward in the current year. So for unabsorbed CA brought forward is those the company has claimed capital allowance, but they do not have sufficient adjusted profit or income to utilize the full CA that they have claimed. So they have this unabsorbed CA that is not utilized. So if this unabsorbed CA is not utilized, they have the option to carry forward to the next few years to utilize it. Okay. So unabsorbed CA must be first deducted against the trade income, followed by all sources of income. We will utilize the unabsorbed CDA starting from the CA from the earliest YA before utilizing the current year CA. So if let's say in year of assessment 2023 now, I have unabsorbed CA from YA 2021, YA 2022. I will need to use the YA 2021 first to set off against my income in YA 2023 before I use the unabsorbed CA in YA 2022 to set off against my income in YA 2023. Okay? Here we have interest income. Interest income from deposits with banks or financial companies is taxable under Section 10(1)(d). And the date when the interest income accrues to the depositor will be taxable in the hands of the depositor. So it's not when the interest is withdrawn or whatever, it's when the interest accrues to the depositor. Okay, so when the interest accrues to the company, it is usually recorded in the profit and loss account, right? So take a look at the tax computation at slide 9. As the income from the deposits with banks and company is a non-trade source income, we will remove this interest income from the net profit before tax to arrive at the adjusted profit. Then we will add back the taxable amount of the interest income after to arrive at the statutory income. Okay, so for example, this you have interest income from banks and finance company. The interest income can be Singapore source and can be foreign source, right? So when all this interest income that no matter whether it's Singapore source or foreign source, it will be recorded in the profit and loss. So we will deduct maybe if let's say I receive a total of 100,000 of interest income. So I will deduct 100,000 from my net profit before tax to arrive at the adjusted profit. Then after I take a closer look at the interest income. If let's say the interest income is Singapore source and maybe 60,000 is Singapore source and 40,000 is foreign source, and the 40,000 of foreign source income is not remitted into Singapore. So I will just add back that 60,000 that is source in Singapore because it is taxable. right, on accruing basis. And then the 40,000 will only be taxed subsequently when in subsequent years when it is remitted into Singapore. Okay. The tax exemption for individual on the interest income received by individual is for your information. Okay, so distribution for REIT. Distribution of REITs may comprise the following component. They have gross distribution income, income that has been taxed on trustee, or non-taxable income, for example, capital gains, and non-income like operating cash flow and unrealized income, like means the return of capital. So out of these four components, right, only gross distribution income received by companies incorporated in Singapore and resident in Singapore is taxable under Section 10(1)(e). Okay. The rest of the three income here, not three income, the rest of the three distribution here is not taxable. Okay, so now let's look at the adjustment to the tax count again. Distribution from REITs is recorded in the company profit and loss account, right? Usually it is recorded as an income revenue in the company's profit and loss account. So the controller of income tax will accord tax transparency treatment to the REIT on a specific income distributed by the trustee subject to certain conditions. The specific income will not be taxed in the hands of the trustee, but will be taxed in the hands of the unit holder, unless the unit holder are specifically exempt from tax. So if the company invested in some REITs, right, the company is the unit holder. So they will be taxed on the gross distribution of the gross distribution from the REITs. Okay. Okay, so again, we look at the format of the tax computation. We need to exclude the entire amount of the REITs distribution from, as it is a non-trade source income, right, to arrive at the adjusted profit. Okay, then later on, we will add back the amount that is taxable, that is the gross distribution amount, to arrive at the statutory income. Okay. Okay, this information on tax exemption of foreign source income received by individuals is for your information. Okay, I want to move on to tax exemption on foreign source income under Section 13(8). So this tax exemption is applicable to foreign source dividend income, branch profits, and service income if the following conditions are met. First, foreign source income must be subject to tax in the foreign jurisdiction from which the income is received. Second, foreign jurisdiction must have a headline tax of at least 15% at the time the foreign source income is received in Singapore. And lastly, CIT, that is the controller income tax, must satisfy that the tax exemption will be beneficial to the Singapore resident. Okay, so just now we mentioned that dividend paid by a Singapore tax resident is exempt from tax under Section 13(1)(ZA). Okay, so if the company has buy certain shares from buy certain shares in the stock exchange, and that the shares in the company that is a tax resident in Singapore, and this tax resident company declares the dividend, and the company receive the dividends, and this dividend is tax exempt under one tier exempt dividend. Okay. Okay, gains and profits from disposal of ordinary shares between 1st June 2012 to 31st December 2027 is exempt from tax if the company holds at least 20% of the ordinary share in the investee for a continuous period of at least 20 months prior to the disposal date. Okay, so in order for you to not tax this disposal of ordinary shares, there is two conditions. One is the company must hold at least 20% of the ordinary shares in that company, in the other company, investing company, and that 20% must be for a period of 24 months, continuous period of 24 months prior to the disposal date. Okay, this slide provides a summary on the types of income and whether the income is taxable on accruing or the receipt basis. All right, this is for your reading also. Okay, so I think we will take a break here, 10 minutes break before we proceed. Okay? Or do you have any questions that you want to ask me first? Any question? Hello?
No,
No.
thank you.
Okay. So, Lei Hong, are you there? Let me check. Okay, let's have a 10 minutes break. We will come back at 10. Now it's 10:12. We will come back at 10:22. Okay?
Okay, thank you.
Okay, thank you.
10 minute break.
Hello.
Hi.
Okay, welcome back. Shall we start with accessible income?
Okay.
Okay, good. Okay. Okay, accessible income is income after deducting losses, donations, and group relief from the statutory income. So statutory income is the aggregate of all sources of income, right? So after the statutory income, we will less off losses, donations, group relief to arrive at accessible income.
Is it the same with the chargeable income, Rebecca?
Yes.
Okay.
So last Saturday, there was a poll questions on donations to approve IPC, right? Institute of Public Character at slide 102. So donations is actually not a revenue expenses that is incurred wholly and exclusively in the production of income. Therefore, it is not deductible under section 14.1. However, if the donation is made to a government or approved institute of public character, the company can claim deduction of 2.5 times of the amount donated. So in the profit and loss account, right, donation is usually reflected as an expense. As the donation is not deductible under section 14, we will add back the donation amount to arrive at the adjusted profit. Then if the donation is an approved donation, we will claim a tax deduction of 2.5 times of the amount donated against the statutory income to arrive at the accessible income. Okay. Carry forward of unabsorbed capital allowance, unutilized losses, or unutilized donation. Okay, unabsorbed capital allowance or unutilized capital allowance in short is UCA, and unabsorbed or unutilized losses is UL in short, and unabsorbed or unutilized donation is UD in short. Okay, where these are brought forward from the prior years are deductible against the statutory income if there is no substantial change in the shareholder and the shareholding at the relevant dates. Okay, so the keyword is no substantial change in their shareholders and shareholdings at relevant dates. Okay. In other words, to utilize the UCA, UL, and UD brought forward from the prior years against the statutory income, there must not be more than 50% change in the shareholder and shareholding. Okay. On top of this shareholding test, to utilize the UCA brought forward from prior years, there must also not have a change in the company trade or business during the relevant dates. The company can deduct a UCA, UL, or UD brought forward from prior years against the current year income indefinitely if the company has satisfied both shareholding test and same trade test. However, if the unutilized donation can only be carried forward to a maximum of 5 years. Okay, for example, the donation made in YA 2023 can be carried forward until YA 2028. If the amount of donations in YA 2023 has not been fully utilized by YA 2028, the amount will be disregarded.
Jadi satu biji 795, satu biji 895.
Okay, some changes here at the header of the slide for clarity. So carry forward of UCA and UL. Okay, in this slide, it talks about the shareholding test. Okay, because in order to utilize the UCA brought forward from the prior years, we need to make sure that there is no substantial change in the shareholding as at the relevant dates. So for UCA, we must see when is the relevant dates. Okay, the relevant dates to utilize this UCA is the last day of the
Yeah,
year of
masih.
assessment in
Jangan
which the
salah.
capital allowance
Waktu dia
arose
anyway, waktu dia scan tu harus lihat.
versus the first day of the year
Iya,
of
tu kalau nanti
assessment
kalau
in
salah
which the
dia
capital
nak
allowance
nanti
is
lebih
utilized.
nanti
So for
patok
example,
keluar
if
kan
the
macam orang
UCA
kadang
for
tak ada.
year assessment
Ini kotak
2015
$20.
is utilized in
Yeah, that's why. Never
2023,
mind lah. Next time then you
the
can
relevant dates will be the last day of the year of assessment in which the capital allowance arose in YA 2015, right? So the last day will be 31st December 2015. Okay, and it is utilized in year assessment 2023. So versus the first day of the year of assessment in which the capital allowance is utilized. So first day is 1st January and the year is utilized is YA 2023 is 1st January 2023. Okay, that is for UCA. For UL and UD, unutilized losses and unutilized donation, the relevant date is the last day of the year, not year assessment, year, in which the losses was incurred versus the first day of the year of assessment in which the losses is utilized. So for example, if the UL for the year ended 31st December 2014 is utilized in year assessment 2023, the relevant dates will be 31st December, that is the last day of the year 2014 when it is utilized, versus the first day, 1st January of the year assessment 2023. So the relevant dates is 31st December 2014 versus the 1st January 2023. So at these 2 dates, we will take out the shareholder, the listing of the shareholder and the shareholding. Then we'll match, okay, this shareholder as at 31st December 2024 versus 1st January 2023, okay, are they the same? So we will see if mostly they are all the same 100%. If let's say I have shareholder ABCD on 31st December 2024, okay, I have the same shareholder ABCD on 1st January 2023, okay, they are the same, there's no substantial change in the shareholding, I can fully utilize the unabsorbed losses and UD brought forward from the prior years. Okay. Waiver of shareholding test. If there's a substantial change in the shareholding, the company may apply to the Controller of Income Tax for waiver of shareholding test. Okay, Controller of Income Tax may waive the shareholding test if, let's say, it is satisfied that the substantial change in the shareholder or shareholding is not for deriving any tax benefit or obtaining tax advantage. If the shareholding test is waived by the Controller of Income Tax, the UCA and the UL can be deducted against the profit derived from the same trade, okay, or business in which the UCA or UL is initially arose. Okay, so remember just now the UL does not have the same trade test. So once they fail the shareholding test, right, and the controller has waived the shareholding test, the UL or UCA can only be deducted against the gain or profits derived from the same trade. Okay, and if the waiver is not approved, the UL and UD and UCA will be disregarded. Okay, let's do a poll to test your understanding on the relevant dates. Okay. What are the relevant dates for the following situation? Losses unutilized in year assessment 2016 and losses to be To be utilized. Sorry, there is a typo. To be utilized in YA 2022. Okay, I will end the poll. Okay, are you able to see the question? Okay, so the question is the losses is unutilized in YA 2016 and utilized in YA 2022. Okay, 2016 and 2022. So for losses, we look at the year, right? So the last day of the year. Last day is always 31st December. Okay, first day is always 1st January. Okay, so last day of the year in which the losses arise. So if YA 2016, the accounting period is 1st October 2014 to 30th September 2015. So the year is 2015. So last day of the year is 31st December 2015. Okay, and then we compare against the first day of the year assessment where the losses are utilized will be YA 2022. So the first day is 1st January 2022. Okay, so last day is always 31st December. First day is always 1st January. Then we will look at whether it is a loss or UCA or UL. Sorry, UL, UCA or UD. Okay, to determine whether should we look at the year assessment or should we use the year. Okay,
Rebecca, can I confirm that the answer is C?
sorry. The answer is 31st December 2015 to 1st January 2022.
Okay, thank you.
Okay, 31st December 2015 to 1st January 2022. So let me go back to just now the slide. For UCA, okay, the way I remember for UCA, because there's a UCA allowance and year assessment, so I'll see A and A, okay, so year assessment. So last day is always 31st December and first day is always 1st January. Okay, so we only change the last day for carry forward. Last day, year of assessment in which the capital allowance arose, so 31st December of the year assessment, that is 2015, right? And then the first day of the year assessment in which the capital allowance utilized 1st January 2023. Okay, so for UL and UD, we look at the last day of the year, not year assessment, year. So we look at the UL is the losses arise in 31st December 2014. That's the last day. Last day is always 31st December. And then the year in which the losses incurred is 2014. And then the first day of year of assessment in which the losses utilized is 1st January 2023. So to compare these two slides, the only difference is the YA and the year. Okay. Okay, so just now we talked about carry forward. Okay, the ULUCA can be carried forward indefinitely. Okay, if they meet the shareholding test, same trade test. Okay, UD can be carried forward for a maximum of 5 years if, let's say, it meet the shareholding test. Okay, now we talk about carry back. So just now we say carry forward, that means previous years have losses and we carry forward to this year where I have profit, I'm going to utilize the losses in the previous year. Okay, now this carry back is talking about now this year, current year, YA 2023, I have losses. Okay, but maybe YA 2021 and 2022, I have profits. So I'm going to use these losses that I have in YA 2023 to set off against the income in YA 2021, YA 2022. Okay, because for you carry back losses, I can only carry back to a maximum of 1 year, that it is the immediate preceding year. Okay, and the maximum amount that I can carry back is Singapore dollar 100,000. Okay, so if let's say in YA 2023, I have losses of more than 100,000. In YA 2022, I have taxable profit, chargeable income of, let's say, 50,000. I can only carry back 50,000. Okay, even though I can carry back up to 100,000 because my YA 2022 only have 50,000. Okay, if let's say YA 2023 I have losses of more than 100,000 and YA 2022 I have profits of 300,000. Okay, I can only carry back the losses in YA 2023 up to a maximum of 100,000 Singapore dollars back to YA 2022. Okay, so the same conditions or no substantial change in the shareholding as well as the same business test, same trade test apply. Okay, now carry back of UCA. Okay, so UCA is the reverse. Just now we say it's the last day of the year assessment, right? So for carry back, it will be the first day of the year of assessment, A and A, year assessment, in which the CA arose, versus the last day of the year of assessment in which the capital allowance is utilized. Okay, so compare to just now that carry forward, now the carry back, there's a switch between the first day and the last day, they swap. But the CUCA is still looking at the year assessment. So if the UCA for the year assessment 2023 is utilized in 2022, the relevant dates for comparing the shareholder and their shareholding is the first day of the YA. So first day of the YA in which the capital allowance arose. So first day is always 1st January, right? 1st January in which it arose is 1st January 2023. So I have 2023 here. And the last day of the year of assessment in which the capital allowance is utilized in YA 2022. So it will be 31st December because last day 31st December, utilized in YA 2022 is 31st December 2022. So these are the relevant dates for us to compare the shareholder and shareholding. Okay.
Rebecca,
Yes.
because we can only use it in preceding year, so this day is always 1 day difference only, right?
In the sense, yes. It's not really in for CA, yes, but you see for UL is different. UL can be 1 year. Okay, let me go through the UL, you see the difference. Okay, so for carry back of the UL, the relevant dates for the UL is first day, 1st January of the year in which the losses was incurred. So first day, the losses was incurred if let's say it is incurred in 31st December 2022. So the first day of the year in which it incurred is 1st January 2022. And the last day of the year of assessment in which the losses is utilized, last day is 31st December, and the year of assessment in which it's utilized is 2022. So it's 31st December 2022. So if let's say just now your question is always 1 day, right? Yes, applicable for CA, UCA, but not really true for UL. Okay.
Hi Rebecca, can I check once it's carried back, right? So there will be a revision for the my previous assessment, is it?
Yes.
Okay.
So what happens in practice is that the company would have already submitted their YA 2022 tax computation. Now I'm doing YA 2023. So when I'm submitting my YA 2023 tax computation, I also submit my YA 2022 tax computation.
Oh, okay.
Yeah.
Okay, thank you.
Together, no problem. Thank you. Any other question? Okay. If not, okay, this slide is for your reading. It summarizes the adjustment to be made in the computation if let's say conditions are met, right? So if let's say you have utilized the UCA, UL, or UD, definitely the year where the losses arose, the UL, UD, and UCA will reduce, and the year where it is utilized, you will have a lesser accessible income. Next, I'm going to move. Yeah.
Sorry,
Any question?
sorry, the UL, right?
Yeah.
Last day of the YA in which the losses is utilized. Last day of the YA 2023, isn't it? Or 31st December 2023?
Are you looking at carry back or looking at carry forward?
Sorry, carry back of UL.
Carry back or
Last day of
UL?
the YA. YA
Last
is
day,
2023, isn't it?
okay,
2023 December.
UL, we look at the year.
Last day.
Last day of the year in which it is utilized. So it's utilized in YA 2022, right?
Oh,
So
sorry,
last day is always.
oh, wait.
Yeah, I think there is a swap because they want to show that, the
Okay.
earlier years is on the left hand side and the later years is on the right hand side. Yeah.
Okay, thanks.
Okay. So for carry back, carry back relief is not applicable to UD. Okay, so carry back is only for UCA and UL. No carry back of UD. Okay. Okay, group relief. Group relief is a system that treats the company in the same group as if they are one single company. Under this relief, the loss claim of one company can be deducted from the assessable income of another company of the same group, subject to certain conditions. So what are the loss items? Again, the loss item is the UCA, UL, and UD. But this loss item can only be current year. Okay, current year loss item. Okay. The company which transfer its loss item is called the transferor, whereas the company which utilize the loss item against its assessable income is called the claimant. Okay, qualifying conditions to claim the group relief is the transferor and the claimant must be Singapore incorporated companies. They must belong to the same group of companies, and it must maintain a 75% shareholding threshold and have the same financial year end. So they must have the same accounting year end. It cannot be the same group or company, one have a June year end and the other one have the December year end. If they have, then it will be they cannot use group relief to transfer their losses. Okay. Okay, I have a question on the carryback relief. That carryback relief is up to 3 preceding year assessment for YA 2020 and 2021. It doesn't extend to YA 2022, okay? It only applies for YA 2020 and 2021. Okay, so for YA 2023, it only carry back to 1 preceding year. 字号 句字 is it? 句字抄 Okay, thanks. Okay, so two Singapore incorporated companies are members of the same group if throughout the entire basis period for that year assessment, at least 75% of the total ordinary shares in one company are beneficially held directly or indirectly by another company, or at least 75% of the total ordinary share in each of the two companies are beneficially held directly or indirectly by the third incorporated companies. Okay. So looking at the 75% shareholding test, we can look at the ordinary shareholding test requirement or look at the profits and assets available for distribution. So if let's say the equity holder can have at least 75% that is beneficially entitled to the residual profit, then it is considered as the profits and the assets available for distribution test is satisfied. Okay, let's take a look at example to understand the 75% shareholding requirement. Okay, so first of all, we look at the parent company, the company A, company B, and company C. Okay, parent company, company A, and company B, and company C must all be Singapore incorporated companies, not Singapore tax resident, Singapore incorporated companies. They must incorporate in Singapore. Okay. So parent, assuming they are all Singapore incorporated company. Okay. Parent will own 100% in company A and 70% in company B. Company A in turn owns 40% in company C, and company B in turn owns 50% in company C. Okay, let's take a look and see if the companies are members of the same group for group relief purpose. So if they are same group, they must pass the 75% shareholding test. Okay, for company A, if let's say parent and company A, they have one of them have losses that want to transfer to each other, can they do so? Yes, because the company A shareholding is directly held by company B 100%. Okay, so 100% is more than 75%. is they can be allowed to transfer their losses. Okay, look at company B and parent. Company B and parent has 70%. So it is less than 75% shareholding. So the losses cannot be transferred. So how about if there's losses in parent or company C, they want to transfer to each other, can they do so? So we look at whether there's any, there is a 75%, okay, that is directly or indirectly held. So in that case, parent does not have a direct holding in company C, but it has an indirect holding through company A and company B. Okay, so how much does it hold through company A? You have 100% times 40%, and you have 40% here. Okay, how much it hold through company B? You have 70% and 50%. Okay, 70 times 50 is 35%. So I have 40% through company A, 35% through company B. Altogether, I have 75%. So my losses, if let's say there's losses in company C, it can be transferred to parent company and vice versa. If parent have losses, it can be transferred to company C. Okay, how about can I utilize losses between company A and company B? Okay, if it is held by the third incorporated company, right? It is also considered a group. So held by third incorporated company. Okay, company A is held by a third incorporated company, that's the parent company, 100%. However, company B held by the third incorporated company, that's parent company, is only 70%. So the losses between, it is less than 75%, right? So the losses between A and B cannot be allowed to be set off. Okay, now let's look at company B and company C. I have company B and company C. Can the losses be set off? Okay, if let's say I have a parent company, okay, indirectly held. Okay, so company B and C, they are directly held by 50% only. So let's look at the parent company and B. So parent company and B have 70%. Parent and C have 75% through indirect holding. Okay, it also fails the shareholding test of 75%. Okay, so parent and B 70%. Just how we determine parent and B 70%. And parent and C is 75% through indirect holding. Is 75%. But because one of them fails the shareholding test, the shareholding threshold, it cannot be allowed to be set off. Okay, so for A and C, again, the 40% is directly held by A, so cannot. So we look at the parent and A. So parent and A is 100%, parent and C is 75%. So can we do so? Parent and C, just now we compute parent and C is 75% through indirect holding. So we have 100% and 75%, so both above 75% threshold, we can allow to set off the losses between them. Okay. Any question? Okay, so no question, I move on. Okay, so under group relief, we mentioned that UL, UCA, and UD for the current year can be set off if let's say they have met certain conditions like Singapore incorporated company, same accounting period and 75% threshold, right? So under what circumstances that group relief, the losses cannot be transferred under group relief? It will be the UL, UCA, and UD of the prior years. So the profits of the current, only the UL, UD, and UCA can be transferred between the groups only for current year. So prior years cannot under group relief. Okay. Prior years losses can only be carried forward or carried back within the company itself. Okay, but under group relief only for current year. And then the second thing is losses attributable to operations of foreign branches. So if we say about Singapore losses, right? Singapore incorporated companies, let's say Singapore incorporated companies have foreign branches that they are making loss. The losses from that foreign branches cannot be used to set off against the assessable income of another company within the same group. So investment allowance, some companies will be given an investment allowance incentive. So if let's say the losses arising from investment allowance, that is unutilized investment allowance, it cannot be transferred under group relief. And losses in respect of income wholly exempt from tax. So if let's say the company has the incentive and they have tax exemption incentive, for example, Pioneer Company, right? And then they have losses. These losses arising from the Pioneer Company cannot be set off against the accessible income of another company. Okay. And losses in respect of specific activities or trade income from finance lease taxable under Section 10C and income from business hiring out motor vehicle and taxable under Section 10F. Okay, then we also have loss items of companies award under certain incentive that cannot be allowed under the Economic Expansion EIA Act. We also have current year UL, UCA of Section 10D companies. Okay. Current year industrial building allowance and the land intensification allowance and donation may be transferred. So not everything can transfer, huh? Only limited to, if let's say it is a 10D company, only the current year IBA, LIA, and donation can be transferred. That means the UCA cannot. Okay. And the UL also cannot. Okay, loss item relating to income under tax remission. So certain as tax remission is an incentive that that the company has. This loss item relating to the income under this tax remission cannot be transferred. And unutilized Section 14N deduction arising in YA 2012 and before cannot be transferred under group relief as well. So how is the group relief reflected in the transferor and the claimant account? So in the transferor tax computation, right, the current year UCA, UL, UD is reduced, whereas the claimant tax computation, the chargeable income is reduced. Okay, the loss item, that is the UL, UCA, and UD, which one will claim for, which one will transfer first, is by the following order. First, current year UCA. Second, current year UL, and lastly, current year UD. Okay, so it must be UCA, UL, then UD, okay, to transfer the losses. Okay, I'm reading the chat. Why? Okay, it's in the act, so I think it's better that we mention to cover everything, because there will be certain times where losses, the company has been making losses for so long, right? So when you carry forward, the losses is perpetual as long as you meet the share this one is group relief. Yeah, so it's actually inside the act. So for Section 19 deduction, it cannot be transferred under YA. Arising in YA 12 cannot be transferred. Yeah. So it's not really applicable also in that sense for YA 2023 because only current year UL, UCA, and UD can be transferred. Okay, so this slide and the next slide is for your reading. The two slides summarize how transferor transfer out its losses and how claimant claim its losses in the event where there is multi-transferor and transferee within the same group. Okay. Okay, so this carry back of UL and UCA for YA 2020 and 2021 can be carried back to 3 years. This is for your reading also. Okay, I want to move on to relief of double taxation on foreign income. This is our last topic for the day. Okay, so foreign income earned by a company may be subject to tax twice. Once in a foreign jurisdiction and the second time when the income is remitted. A tax resident in Singapore can claim foreign tax credit against the Singapore taxable income against the Singapore tax payable on the same income to mitigate the double taxation. There are two types of foreign tax credit. One is double taxation relief under Section 50, where income is received from a jurisdiction that has a tax treaty with Singapore. And the other one is unilateral tax credit under Section 50A, where income is received from a jurisdiction that does not have a tax treaty in Singapore. And the qualifying conditions to claim foreign tax credit is that the person who claims the tax credit, that company, must be a Singapore tax resident company. There must be tax paid on the income in the foreign jurisdiction, and the same income is subject to tax in Singapore. So 3 conditions. And foreign tax credit is allowed on the lower of the actual amount of foreign tax paid versus the amount of Singapore tax attributable to the net income. So by default, right, the foreign tax credit is computed using source by source and country by country method. However, the company can elect to compute the foreign tax credit on a pooling basis. That is to aggregate the foreign tax paid on the foreign income and compare it to the Singapore tax attributable to the net foreign income. Okay, so if the company is in a loss, the Singapore tax resident company is in a loss, there's no foreign tax credit given to the tax resident company in Singapore. The formula to compute the amount of Singapore tax attributable to the foreign income is using the gross taxable foreign income divided by the total taxable income from all sources multiplied by the Singapore tax payable. Okay. Do you have any questions before we move to case study? Any questions? If not, can you bring out your case study question and answers, case study question 2? Do you have a copy?
Yes.
Yes. Okay, I try to share the see whether if I can share 2 screens at the time. Is it too small for you? Let me open up the file first. Case study 2. Are you able to see? Is it too small?
Can see, it's okay.
Yes, can see.
Okay. Let's see whether I can share the Excel also. Let's share side by side. Okay, if you have the question, I think I will just share the answer. Is it easier for you?
Yeah, okay also.
Yeah, so let me close this one first. You are looking at the answers, right?
Yes.
Okay. Okay, if you have those who do not have the question, please let me know so that I can show you the question first. So everybody have silence means everybody have, is it? I cannot see you, I cannot hear you. Can you respond?
Yes, we have. Those who collected the notes will have a copy.
Okay, can. Thank you. Okay, so for the question 2 case study, we have given a profit and loss. Okay, okay, I go through this one first. Sorry. I want to go through the questions first. Okay, so for question 2, we have a profit and loss account where we have revenue, then we have cost of goods sold, then we have expenses to arrive at the net profit before tax. Okay, then we have some notes to inform you about the additional notes. So in the in the profit and loss, you will have note 1, note 2, note 3, note 4, right? So you will refer to the note 1 for additional information. Okay, so for note 1, we have income, note 2 also income, note 3 also income. Then from note 4 onwards until note 10, we have expenses. Okay, so just bear in mind, note 1, 2, 3 is income, note 4 to 10 onwards is expenses, and note 11 is about assets that is acquired in the by the company in prior years. Note 12 is about new assets that is acquired by the company in the current year. Note 13 is about the unutilized losses. And note 14 is about group relief. Okay, so the question asks, please prepare tax computation for the company for the year assessment 2023 together with the relevant calculation working. Show all capital allowance and special allowance claim on itemized basis. Assume the company has applied accelerated deduction or capital allowance in year assessment 2023 where applicable. Okay, then now I want to show this one. Yeah. Okay, so just now I share with you the tax computation question, right? Okay, are you looking at the profit and loss account? Okay, the first step that we always take for tax computation is we make a discussion question, okay? So I need your participation on this. The first line in the tax computation, if you look at slide 9,
Net profit before tax.
yes, net profit before tax of 649,290. Okay, that is always the first line in the trading company tax computation. Okay, second step, what do? We remove all the separate source income, right? Income that has already been included in the profit and loss account, we will remove that. So if you look at the profit and loss account, you have the sales, you have the dividends, interest, distribution, and losses on the property, investment property. Okay, so my first item here, net profit before tax. I have the net profit before tax. Then I'm going to look at the line that is below the sales, that is dividend. If you are looking at the question, dividend from Singapore Bank, DBS Bank. So are they trade source income?
No.
No. So I remove 30,000 trade source income, non-trade source income. Okay. Then the second item, dividend received from bank in Indonesia, 15,000. Is this a trade source income?
No.
No, I remove 15,000. Okay, next, interest from Singapore fixed deposit. Is this trade source?
No.
No, less out. And interest from Australia. Is it a trade source?
No.
No. Okay, so we see whether it is okay, it's not a trade source. I remove 18,000. Distribution from Mapletree Industrial Trust. This is a REIT. Okay, so it's a REIT. It's not a trade source. I also remove. And loss on disposal of investment property is also not a trade source. So if it is a loss that is reflected in the profit and loss, is a minus sign. When I reverse out, I will have to add back. It's a plus sign. Okay, same for the income. If income is included as a positive amount, then I will less out as a negative amount. Okay, here. Okay, so far so good.
Yes.
Okay, thereafter I will less out everything and add back. I will have an amount of 592.0. Okay, then now I look at the question, the profit and loss account. I look at the question. I stop at loss on disposal of fixed property, right? So I'm going to cost of sales, cost of goods sold, no adjustment needed, right? So I skip all the way down to accounting and audit fee. Okay, these are expenses. So expenses, it is deducted to arrive at the net profit before tax. If let's say expenses is not deductible, I will have to add back. So let's look at line by line and see whether what are the expenses I should add back. Accounting and audit fee, is it deductible?
Yes.
Yes, so no adjustment. Cash donation to Cancer Society, is it deductible under section 14.1?
No.
No, so I will add back cash donation of 1,000. Okay, depreciation 25,000, is it deductible?
No.
No, add back. Entertainment and traveling expenses of 30,000, is it deductible?
Note 4.
Okay, you have to look at note 4. What does note 4 say? Inside the entertainment and traveling expenses, we have getting lunch for managing director son costing $10,000, where business associates are invited. So is this considered as deductible expenses?
No,
Expenses for wedding lunch of managing director son.
no,
Is managing director son an employee in the company?
no.
So is the private expenses of the managing director?
Yes.
So it is not deductible. So out of the 30,000, I only add back 10,000. Okay?
What if the son is an employee in the company?
Then it will state whether it's an employee. Then if it is an employee, is it considered as a staff benefit?
Oh,
Is
okay.
it available to all the staff? Or is it only just to the managing director staff? You know? So we
Okay.
have to see whether it applies to the staff all have to have the fair share. Huh? Okay. So next is the general. Okay, I'm looking back at the profit and loss account. General and admin expenses. I have 12,000. Okay, that is a note 5 that I need to look at. Note 5 says that general and admin expenses include prayer expenses of $1,000. Is it deductible?
The prayer expenses.
General deduction formula under section 14.1. Is it only and exclusively incurred in the production of income?
No.
No. Okay, so prayer expenses I will add back as 1,000. Okay, then next I'm looking at the higher purchase interest. Is higher purchase interest of 1,155 deductible?
Yes.
Yes, it is deductible under section 14.1. Okay, so then it is deductible, I don't make adjustment, right? Legal and professional fee of 12,500, note 6. It states that legal and professional fee includes the payment to ABC law firm to defend suits that company is facing for breaching contractual term under the sale contract of $8,000 and for drafting new tenancy agreement. Okay, so there is two expenses here. $8,000. The company is facing a lawsuit for breaching the contractual term under a sale contract. Is this deductible?
Yes.
Why?
It's related to the production of income.
It's a trade source income, right? Because when you do business, you do have facing lawsuits, right? It's part and parcel of the income is incurred in the production income. Okay, so for drafting new tenancy agreement, is it deductible?
No.
No. Why?
Because it's a new tenancy agreement. He's haven't even producing an income for the company.
Okay, so it is incurred for enduring benefits, right? So it is not deductible. Okay?
Sorry, Rebecca, if renewal tenancy agreement.
Renewal is deductible.
Okay.
Okay? Okay, the next one I'm looking at below legal and professional fee is medical expenses and medical insurance, okay, of 9,000. There is a note 7. So you can take out a separate piece of paper, to do your computation under a different schedule for medical expenses. So let's look at medical expenses at note 7. It says that the company has not implemented the portable medical benefit scheme, transferable medical insurance scheme, or does not provide inpatient medical insurance benefits in the list of portable medical shield plan. So what does this sentence mean? What is it trying to say?
Only can claim 1%.
Yes. So it doesn't implement any of the portable medical scheme, only 1%. What if the company has implemented?
2%.
2%. 2% or what?
Salary
The
remuneration.
employee remuneration.
Okay, so the staff remuneration, right? So since the company did not implement the portable medical scheme, it is only restrict to 1% of the staff remuneration. Okay, so let's look at the profit and loss. Profit and loss says that medical expenses and medical insurance is 9,000. So I'm getting a separate piece of paper. You can see the medical expenses here is 9,000. I will put 9,000 here. Okay, then it is restricted to 1%, right, of the employee's remuneration. So I go down the list and see whether is there any employees remuneration. Okay, salary and CPF. Okay, note what? Note 10 also have. Okay, so my salary and CPF is 90,000. Okay, but inside the salary and CPF, I have a general provision for leave pay. So is the general provision for leave pay incurred already?
No.
No. Okay, so I have to remove the 2,000 out from the 90,000. Then my salary and CPF is only 88,000. Right?
Yes.
So if I go down the list, okay, I don't see any other expenses that is relating to staff remuneration. Okay, there's no allowance, don't have other bonuses, right? So that is my total remuneration for staff is 88,000. I apply 1% is 880. Okay, so I have incurred 9,000, but the amount allowed is 8,000. The amount allowed is 880. The amount I disallowed will be 8,120. Okay, so if this amount is disallowed, what do I do? Because I have already have a deduct amount of 9,000, right? The amount that is not allowed, what should I do?
Add back.
I should add back. So after I compute this 8,120, I will put in my main tax computation 8,120. Okay? Can? So far so good?
Yes.
Okay, then after my medical expenses, I go down the profit and loss account again. I look at motor vehicle expenses. Motor vehicle expenses, they have note 8. It said include delivery van expenses of 25,000 and expenses in relation to a Volvo provided for general manager use. So Volvo is that not very clear. Volvo can be a car, can be, okay, usually it's a car because for general manager use cannot be driving a bus, right? Cannot be driving a van. So in this case, we treat it as a car, okay? So there's a delivery expenses, delivery van expenses of 25,000. Is it deductible?
No.
Yes.
Not delivery van, yes.
Yes,
Delivery
van.
van, yes, because delivery van is the company van, it's not an explated. Okay? So 25,000 is deductible. Do I need to make any adjustment for this 25,000?
No.
No. Then the expenses in relation to the Volvo provided for the general manager use. So I assume that this Volvo is a car. Okay, a private car, right? Cannot be general manager drive a bus home. So, sorry?
Sorry.
Question?
No, I was unmute mine. Sorry. Yeah.
Okay, no worries. Okay, so I have a Volvo that provide for general manager use, and then the expenses in relation to the Volvo is 13,500. So is the 13,500 deductible?
No.
No. Why is it so?
It's a private car. It's plate.
Okay, it's a private car. Okay, even though the company buy for them, provided for the GM, it is still a private car. Okay, so 13,500 is not deductible, but I have already included in my profit and loss account. What should I do?
Add back.
Add back. Okay, so in G's, I only allow the 25,000 only. Okay, if I add back this 13,500.
Okay, Rebecca, can I ask the question? Is it motor vehicle expenses? It should be 38,500, right? Is a
Yeah,
print
I
out is
think
wrong,
that
is it?
is a typo. There's
Okay,
a
okay,
typo
okay.
here. Okay, so we assume that the amount is correct, huh? Okay. Then next one is provision for warranty. Provision for warranty, they have a note 9. Note 9 shows the movement in provision for warranty. There is a brought forward of 25,000, provision of 30,000. Then we have a utilized amount of 10,000. Okay, so as at 31st December is 45,000. So the amount that is 30,000 in a P&L is actually the provision, a general provision of 30,000. So what should I do with this 30,000? Is it deductible or not?
No.
It's a warranty. It's a general provision.
No.
No, okay? A general provision means why is it not deductible?
Because not yet happen is
Not yet
general, right? Not incurred.
Yeah, general not incurred. So our section 14.1 deduction formula, it must be incurred in the production of income. So general provision haven't incurred yet, right? It's only a provision. So the 30,000, I will have to, I have already included in my profit and loss account. I will have to
Add back.
add back. Okay, I add back 30,000. Okay, but in note 9, it gives me more information. Okay, so I have provided for 30,000, but actually I used 10,000 already. Utilize, is it incurred?
Yes.
Yes.
Yes. So this 10,000, is it deductible?
Yes.
Yes. But is this 10,000 reflected in the profit and loss account?
No.
No. Then what should I do?
Deduct it.
It's not in the profit and loss account. I should claim it, right? Even though it's not in the profit and loss account, I am trying to reduce my chargeable income, right? So long as it's deductible, I'm reducing my chargeable income, right? So even if this is utilized, it is in the balance sheet, it's deductible, it's not in my P&L, I should deduct the amount of 10,000, okay? So I add back 30, I less than. My net amount to add back is
10.
Here in the answer, provision for warranty, I add back 30, I less than. The total amount I need to add back is 20,000 only. Okay?
So Rebecca, can I confirm? So let's say if it's not in P&L but we are eligible to claim it, so we can actually tax and we put it under the expense to claim it back. So actually tax doesn't really follow the sort of like accounting, right? We need really to see both sides, P&L and balance sheet.
Because some of the amount is capitalized, some of the amount is, just now I mentioned that there is some revenue item that is capitalized. So revenue item that is inside the balance sheet but not in the P&L, but it's allowable revenue item, so it's allowable for deduction, I will have to less it out.
Okay, got it. So in this case, can I ask also if it's a specific provision for warranty, it should be claimable, right? It's specific.
Yes.
Yeah, okay.
Yes, provision for warranty. So the company must be able to justify that why is it a specific. Probably that, as at year end, there is already ongoing some of the warranty claims already. And then the company is still fixing and things like that. So they foresee that they will incur this provision in the next few days after the year end or whatever. So they have this specific provision. But for general provision, they may be based on estimate that, okay, usually my business trend is about this, I should have a general provision of this amount. Okay, but these are not incurred, right? So they are not deductible. For general, specific is deductible.
Okay, got it.
Okay.
So Rebecca, Rebecca, I have a question, right? So let's say you have the provision for you actually add for provision for this year. Then for next year, when you reverse the provision, so are you going to less this provision amount?
Okay. So if let's say you have a provision amount and then later you have a write back, right, of that provision. So usually in the write back of provision, where will it be reflected in the profit and loss account?
Be income on the top, or
It will
maybe
be reflected in the profit and loss account.
yeah.
Okay. So if it is a general provision, right, then we add back, right? Then if it is a write back of a general provision, is it taxable?
Yes.
No, it's not taxable. So it's like reversing out your general, you know.
Oh yeah. Sorry. Yeah. If general we never deduct, so when there is how to say, as what Kevin asked, there is right back, then we don't need to do anything next year. But if it's, let's say, it's specific, we already deducted before, then the next year when we reverse it, we need to put it back, right, as a taxable. Am I getting it right?
Yes. But if let's say your specific is already inside your P&L, do you still make adjustment?
No.
No.
The write back, you don't make adjustment because it's taxable, it's supposed to be there, I don't touch it.
Yes.
Okay, so basically our adjustment, we are removing those that is non-deductible, okay, and non-taxable. And this non-deductible and non-taxable amount has already been included in the P&L. And then we also left out those that is not included in the P&L but allow for deduction.
So it's correct if let's say next year I reverse this provision for warranty, right?
General provision or specific
No, I'm
provision?
just only this like provision for warranty. So in the event that they really claim this warranty, then I incur expenses. So I need to reverse this provision. So I need to put this less provision on the top bucket, right? The less separate from source income.
Okay, there is two types of reversal. Just now you mentioned you have incurred. You have incurred means utilize. If you write back with, which means you over provide, and then you think that maybe this year I think I have over provide last year, right? So this year I need to write down to reduce my 45,000. Correct. So that write back is actually already inside your P&L. But the amount utilized is not inside your P&L, it's in the balance sheet.
Sorry, can I clarify? If it's a specific, but it's a provision, specific provision is also not deductible, right?
Specific provision is deductible.
Oh, it's deductible.
Yeah.
Can you give example of specific provision? Can you give example of what is a specific provision?
For example, stock obsolescence. So you go through your inventory, the inventory manager go through and say that all these are maybe not so sellable already. We want to discount all these and sell. Then they have to write down to their net realizable value, right? Then they have this provision for stock obsolescence. They are able to identify that these are the stocks that is going to obsolete, and then they provide a specific provision for that. So for general, it's like they are able to identify which particular thing. They just say, okay, this whole lump sum, I probably estimate 5%. So you are not able to identify, not incurred.
But warranty usually refers to warranty of products, right? So isn't it quite specific already?
Not really. So if let's say, for example, you buy a company that is selling household equipment, right? So household equipment, they have give you 1 year warranty. So the customer may or may not come back, to say that there's a faulty issue, right? But they have to provide that, I have this warranty amount. Based on my last year estimate, probably 10% of the consumer will come back to me and claim for warranty. But is there 10%? No, it's just the estimate based on the previous year. So this amount of provision is not incurred. It's only an estimate. But for accounting on prudence basis, you all need to account for it, right? Because on grounds of prudence, whatever provision you have to put it inside the P&L. But for tax, we only allow for those that has incurred. So specific provision are those provision that they are able to identify that is going to incur in the next few days. It's just like accrual like that. You know, I'm going to incur already. I haven't finished my job, my repair job for my consumer yet. Something like that.
For this example, right, you accrue, you provision for warranty 20,000. So next year I reverse 20,000, but my actual warranty expenses is also 20,000, meaning my P&L for next year for this cost is zero, right? Because I have provision. So meaning actually I need to I think less 20,000, is it?
So
Or is
you
that
are looking
calculation?
at note 9, is it? Are you looking at note 9?
I do not have any notes. I'm just looking based on your screen.
Oh, you don't have the question, case study question?
I do not have. Is it a physical copy that
Just
collection
now I
from?
was mentioned whether you all have the question.
Yes.
Okay.
Some of us, yeah.
Okay. You hold on. I think it's important that you know the question. Let me switch my screen. What's this again? Give me a while. Let me try to switch the screen. Okay, this one. Two. Okay, are you able to see?
Yep.
Okay, so just now I mentioned that this is the profit and loss account. So I have gone through line by line already. How much is what are the non-trade source income? I less up everything. Then I am going through the expenses on what are the non-deductible expenses line by line and see what I should add back. Okay, so far I'm until this provision for warranty. Okay, so provision for warranty, there's a note 9. It says 30,000. Okay, so I going down to note 9 to see the 30,000. What does it say? Okay, I have a brought forward figure of 25,000. I have a provision for the year of general provision 30,000, the one that I recorded in the profit and loss. Correct? Then I have the amount utilized during the year of 10,000. This amount will not be reflected in the profit and loss. It will be reflected in the balance sheet. Okay, and just now you asked a question, how about if I write back? If I have over provide 30,000, maybe I should only provide 10,000, right? Because I only utilize 10,000, then I over provide. So next year I'm going to write back this 20,000. So when I write back this 20,000, I put 30,000 in my profit and loss this year as an accountant, not tax consultant, accountant. What should I do? I over provide. I should write back to my profit and loss, right? So the accountant will put it in the profit and loss of 20,000. So when that write back is an income of 20,000, right? Is a receipt of 20,000. Actually, is a reduction of expenses of 20,000. Since last year, I have already add back. This year, I will less out. Do you understand?
Yeah, because I think that the 10K should be for next year, right? The minus 10K. It's not within the year already.
No,
but if it's the
10K.
movement.
10K could be those that provide in previous year 25,000.
The current year.
Then
Okay.
I utilize this year 10,000. So this 10,000 is not inside the P&L. If you see the P&L is only 30,000.
Okay.
Okay, so now I have this 10,000, which is not in the P&L, is in the profit, is in the balance sheet. I have to remove it. I have to deduct. Okay, because I have it incurred.
Okay.
Okay. Any question?
I think I have one more question. It's on the REITs, right? The REITs, when I read from your previous slides, right, it's actually taxable, but you excluded it from the income.
Yeah, here. Why I excluded here? Because in the first section, we always have the first line is net profit before tax, right? After the net profit before tax, we will less the separate source income. Because REITs is not a trade source income, that's why I removed the entire amount.
Okay.
Okay, then subsequently, I'm going to add. I'm going to
Okay,
add
understand.
the REITs. Okay, so I
Okay.
haven't go to the add back yet. I deduct first because I want to find my adjusted profit. So adjusted profit, to find adjusted profit is actually the trade income under section 10(1)(a). So if those that is not a trade source income and those that is not a deductible allowed under trade source, I will remove everything because I want to find what is my adjusted profit. Okay,
Okay, good.
so to find the adjusted profit, it could be a loss also. You have too much deductible expenses. Okay, then it becomes a trade loss, and then that's where you have your loss item, right? Your unabsorbed loss. Then you can carry forward, or carry back. Okay, so
Okay.
I must first find my adjusted profit. Very important to find the adjusted profit.
Okay, clear. Thank you.
Okay, Ken, thank you. Any other question before I move on?
Hi, Rebecca. Can
Yes.
I ask if audit fee usually consider a general provision?
Audit fee
not-
usually is accrued expenses.
Yes, that's right.
So auditors, right, they will usually tell you, okay, this is the sum of money. They will usually when the accountant and the auditor, right, auditor is external party, then the auditor will tell you, okay, for me to audit your company accounts, this is my cost. Okay, but the auditor haven't complete the thing, right?
Yes.
But these are the expenses that they are going to incur. Okay, so this is the accrued expenses, or in fact, they have already done the work, but auditor has not give you a bill. So this is called accrued expenses.
It could be the work usually the work only provide the following year, right?
Yeah, so it depends on whether the audit fee is, now this audit fee is the following year or the current year. Sometimes the audit fee can be interim audit. That means you don't need to be at the year end. It could be in the midst of the year where you have quarterly reporting or half yearly reporting for those company that is listed in the stock exchange. Yeah, so there's ongoing audit going on. So these are also audit fee. So whether or not it is a provision is for the accountant to record. Should it be a provision or accrued expenses? Okay, then the accountant will give you a list of all these tax, this profit and loss. Then from the profit and loss, they'll give you a summary. Okay, inside this profit and loss, what have I accounted for here and this and that. Then you, based on what the accountant give you the information, you make the adjustment.
Okay.
Okay.
So the audit fee, if the work is done in the current year, we can expense out. But if the work would be done in the following year, we need to put it back, right? It's a disallowed. Consider the general provision.
If accountant tell you it is a general provision, then it is disallowed. But generally, audit fee is accrued expenses.
But the work is not done yet. It would be done next year.
Yeah, the work, but they were telling, sometimes they will do a preliminary audit, Audit doesn't mean that necessary when accountant have to close all their books, then auditor will come in, but auditor may come in to do a preliminary, like before the year end, they will test certain records, you know. Maybe if let's say my accounting year end is January to December, then the auditor may say, okay, I want to come down and do some testing first to test your records until January to September. Okay, then after next time after you close your year end, I only need to test another 3 more months. So the auditor already comments their work already in that sense. And
But
then
they
yeah.
did it only for 9 months. They did not do it for the 3 months. That 3 months would be done next year only.
So they already tell you that, okay, before they commence the fee, they already give you a quotation. This is the amount that I'm going to charge you for your fee. Right?
Okay,
Mm.
thanks.
Okay, thank you. So the accountant will usually tell you whether that fee is a accrued expenses or provision. Okay? Any other question before I move on? Okay. If not, then okay, so just now we are at provision for warranty, right? Then we will go down and see training, staff training. Staff training is external. Is it considered as deductible?
Yes.
Yes, it's for the staff benefit to improve the staff efficiency or things like that. So it is part and parcel incurred in the production or income, and it will be deductible since the amount already included in the profit and loss. Do I still need to deduct it?
No.
No, so no adjustment for training, staff training. Next one is salary and CPF. Salary and CPF is usually deductible, right? But we need to take a look and see what is it inside the salary and CPF that is not deductible. So we look at note 10. Note 10 tells me what? Tells me that inside the CPF and salary, there is a general provision for leave pay. So which means that some of the staff did not take their leave. Okay, then probably the company need to encash the leave in future. And this is an estimated amount. So it's a general provision. So is this 2,000 deductible?
No.
No. Okay. This 2,000 is not deductible. It's not incurred yet. And the salary, it is included in the salary. Okay. So it's in the P&L. So what should I do?
Add back
Add
2,000.
back the 2,000. Okay. So I have to add back this 2,000 in the provision for leave pay under the disallowable expenses. Next, I have tax compliance fee. Tax compliance fee 3,500. Is it deductible?
Yes.
Yes.
Yes. Why is it deductible?
To comply with the tax regulation?
Yes. So we have a section called the tax statutory and regulatory expenses that is deductible, and compliance fee is part and parcel of your business trade, right? So it is deductible and it is inside the P&L. Do I need to make any adjustment?
No.
No. Okay, so no adjustment. How about utilities of 20,000?
Okay, no need.
No need, because utility is deductible and it is included in the P&L, so no adjustment. Okay, so let's take a look at the tax computation. Okay, in my tax computation, I have starting point, net profit before tax, I left out all the separate source income, those non-10(1)(a) source income like dividend, interest, REITs, and disposal from investment property. They are all non-taxable or non-section 10(1)(a) source income. I left them out. Then I also add back those disallowable expenses that has already been included in the profit and loss account. So they are not allowable. So I have to remove them out to increase my chargeable income, right? And those expenses that is deductible but is not reflected in the profit and loss account, what do I do? Anybody? Those expenses that is deductible but it is not included in my profit and loss account, what should I do?
Claim it back.
Claim.
Less.
Claim.
Less.
Yeah,
Okay,
less.
to reduce my chargeable income. Okay, always remember that ultimately I'm trying to compute is my chargeable income. Whatever expense that I add or income that I deduct, will it increase or decrease my chargeable income? Okay?
Okay.
Can? Okay. So after that, after all the add back all the disallowable expenses, right? That means I have 677,410. Okay. This is the adjusted profit before section 14N deduction. Okay, follow? So which means that 677,410 includes all the deductible expenses and all the trade source income. After trade source income less deductible expenses is this one. But I'm working backwards from the net profit. Okay? Can? So far follow or not?
Yes.
Yeah, okay. Don't follow, you have to stop me. Okay? Okay, now we look at okay, let me share the question. Okay, for the benefit of those who do not have the question, when I'm sharing the question, I switch over the question and answers, okay? So now we have dealt with until 10 already, right? So we are going to look for any section 14N deduction because section 14N deduction is also deductible to find out your adjusted profit, right? So let's look at the acquisition for the year or the previous year. Okay, question note 11. The company has acquired the assets in the prior years, then they have this office equipment and furniture, and they claim this section 19A capital allowance. Okay, so these are capital allowance. I'm not looking at it first. I park it one side. And then during the year, the company incurred the following as capital expenditure. They have inventory software, management software. That one is capital allowance. Then CapEx for office, is it section 14N deduction? CapEx for office, is it 14N or is it capital allowance?
Capital allowance.
Capital allowance. Okay, tables and chairs, is it capital allowance or section 14N?
Capital allowance.
Capital allowance. So that one I park in one side first. Renovation and refurbishment. Okay, I have flooring 213,000, fixed partition 58,000, false ceiling 55,000. The renovation and refurbishment did not require approval from Commission of the Building Control. The company did not carry out any R&R expenses in the prior years. So that means this is all I have incurred. Okay, so let's look at flooring. Flooring 213,000. Is this a qualifying capital expenditure under section 14N?
Yes.
Yes. Okay, so qualifying capital expenditure, there's a slide on the qualifying capital expenditure under section 40, and remember them. These are the deductible qualifying expenditure, okay? How about the next one? Fixed partition, 58,000. Is it a qualifying expenditure under section 14N?
Yes.
Yes. So I add 58,000. How about false ceiling? Is it a qualifying expenditure under section 14N?
Yes.
Yes. So I add back the not add back. I also add the 55,000. So altogether, how much is my section 14N R and R qualifying expenditure?
326,000.
326,000. Is there any qualifying capital expenditure incurred in prior years for section 14N?
No.
No. So I will have the 300,000 all for this year because qualifying capital expenditure is capped at
300,000.
300,000 for 3 years. So if my previous year I have never claimed before, so this is the first year I claim, I can claim a maximum of
100,000.
300.
qualifying capital expenditure.
300.
300,000.
300,000. Okay, so maximum I incur 326,000. I can only have a qualifying capital expenditure of 300,000. My 26,000 will be forfeited. Okay, so then I have 300,000 that is qualifying capital expenditure. How much can I claim as a deduction for the year assessment 2023?
100,000.
100,000. Can you explain how you get 100,000?
300,000 divided by 3. For 3 years.
300,000 divided by 3 years. Okay, 300,000 divided by 3 years, you get 100,000. So in my tax computation, I will deduct 100,000. Okay, so in my tax computation, I will deduct 100,000 here. Just now I compute, right? Then I have 100,000. So after I deduct section 14 and 100,000, what do I have? I have an adjusted profit before capital allowance of 577,410. Okay, so if you look at your tax computation format at slide 9, what is the next step that you should compute?
Rebecca, there's a revenue items capitalized, right?
Mm.
Can you give example?
Where do you see the revenue item
It's in
capitalized?
the sample in slide 9. After you do section 14N, the next line is revenue items capitalized can also be deducted.
So example would be renovation. If let's say your renovation is only for repair can be deductible under section 14(1)(c), right? But repair sometimes together when we get contractor to do, we repair then do some major renovation and things like that, right? So we lump everything under renovation expenses. Correct or not? Accountant don't look at details. Oh, this one is repair or this one is section 14N, because accountant may not have the knowledge of the tax computation. They only prepare the accounts based on the FRS, right? So they will look at, okay, this is renovation. I will capitalize this under renovation. But when I look at the renovation, hey, this renovation part of it is actually repair. I don't claim under section 14N. I claim under section 14(1)(c). So these are the revenue item that is capitalized in the balance sheet.
Okay.
So these are the examples. Okay. Okay, I have a chat. Let me see if there's a question. Okay, no question. Okay, so now if I look at my slide 9, my next step is to
capital allowance.
Yes, compute the capital allowance. Okay, so I need to go back to my question and see what is the capital allowance that I can compute. Okay, so for just now, we know that until note 10 is all the expenses, right? There's no capital allowance before note 11. So now we look at assets acquired under by the company in the prior years to look at capital allowance, right? So capital allowance assets that is acquired in the prior years in year 2021 and 2022 can claim accelerated capital allowance under section 19A1E over 2 years, correct? Yes?
Yes.
Now it's in YA 2023. So for year assessment 2021, I have claimed okay, so I have claimed, let me see, maybe the question is correct. Oh, sorry. It says that it has not elected. So for the year assessment 2021, the company actually can have an accelerator, but he didn't claim under section 19A1E. They claim under section A1, which is over 3 years. Okay, so 330,000 over 3 years. Per year I claim how much?
10,000.
10,000. Okay, 1/3 of the amount, right? So the first year that I claim is how they say left only 1 year. So I have claimed in year assessment 2021, year assessment 2022. Now in year assessment 2023, I can claim how much?
10,000.
Okay, I have a tax written down value of 10,000. I will claim 10,000. Then for the assets furniture that is acquired in year assessment 2022, it gives information that the company has claimed under section 19A1E. Section 19A1E means what? They claim over
2 years.
2 years. And what is the ratio that they claim?
Ratio
25.
Okay, so it balanced with 25 in year assessment 2023. The first year of claim for 2 years is not, the 2 years is 75 and 25 ratio, right? So first year where they acquire in year assessment 2022, you will claim 75% of the 6,000. Then in YA 2023, which is the YA that I'm computing, it will claim 25% of the 6,000, which I have arrived at 1,500.
Yes.
Okay, then C. Okay, so I have 10,000, I have 1,500. So C, note 12. Note 12, what do I do? Note 12 have inventory management software. Can I claim CA on this?
Yes.
Under which section?
Section
19A2.
19A2 over how many years?
1 year.
1 year. So I can claim the full amount 10,000 in YA 2023 because this is the year that I incurred. Okay, how about carpet for office? Just now we say that this is capital allowance, right? Carpet for office incurred in year assessment 2023.
3 years.
Over? Sorry, cannot hear you.
3 years.
Yes.
3 years.
Over 3 years. Okay, so 12,000 divided by 3 years. So I will claim how much this year? 4,000. Okay, so I have 4,000 already. Okay, renovation and refurbishment, the part D already accounted for under section 19N. So I'm not going to look at it. Then prior years, is it relating to CA? I'm not going to look at it. Number 14 is group relief. So that's all for my computation for my capital allowance, right? Let me move to the tax computation. Okay, so again, you will use the schedule under the capital allowance. You don't do it on the tax com. You take a separate piece of paper to do your tax computation calculation for your capital allowance. So I have just now, I have the office equipment that acquired in year assessment 2021. I have the cost is 30,000. I have remaining year or 1 year period, my tax written down value is 10,000. I claim the full amount of 10,000 because left only 1 year. Furniture, I have 6,000. I claim under section 19A1E over 25%. So I have 1,500. Okay. Then software, I have 10,000 full amount under section 19A2. I have carpets that is under section 19A1, that is 4,000. I have tables. Just now have tables and chairs. Oh yeah, we have one table and chair that we didn't see here. So just now there's a table and chair. Okay, table and chair. Wait, let me change my screen first. Okay, so tables and chairs is here. Okay, tables and chairs each cost 300. And the total amount is 36,000. What should I do? Where can I claim this? Under which section?
19A, 10A.
19A, 10A is a low value asset, right? So what is the maximum I can claim under section 19A, 10A?
30,000.
30,000 because the cost of each asset is less than
5,000.
5,000. Okay, so I have 36,000. What should I do?
Claim max 30,000, then the 6,000 split into 3 years.
Yes. So I have 36,000. So I will claim the maximum of 30,000 under section 19A, 10A, and then I split the 6,000 over a period of 3 years under section 19A, 1. Okay. Let's see the tax computation. Okay, so I have the tables and chairs. Just now, 36,000, right? 36,000. So claim 30,000 max under section 10, section 19A, 10A. Then the 6,000 divided by 3 years, only 1/3 I can claim. That is 2,000. Okay, so I have a tax written down value to be carried forward to next year for those years that I haven't claimed. Can? This is the working for the tables and chairs. Okay. So after you have computed this, you have this section 19A. Yes.
Can I check if during exam, do we need to draw this table out?
You don't need to, but you need to know under which section you are claiming, because the section will tell you whether you can claim under which year. Or you don't need to tell me the section. You let me
So
know
this
when
is
you are claiming, how much you are claiming, like how many years. Your working have to show very clearly if let's say it's tested.
right. Okay. Thank you.
Rebecca, is it need to put the 90A1, 1E2, or can we actually just write like low value asset, claim 3 years, accelerated 2 years? Is it workable?
Can. As long as it's clear that you're working, how you arrive at the amount, I think it's okay.
Okay, thank you. Because it's something cannot remember really exactly the section. Okay, thank you.
Yeah.
So, sorry, how much time we will get to do this kind of question in the exam?
How much time? I don't know how much time your exam is given. How many hours?
3 hours, I think.
3 hour 15 minutes, I think.
Huh? How many hours?
3 15 minutes.
Yes,
3 hours 15 minutes.
Yes.
Okay. So 3 hours 15 minutes is over how many questions? How many questions do you have?
You don't know?
5 or 6, I think.
So usually I think it depends on how many marks is awarded lah. Then you have to portion and see, you know, how much time you should spend on each question. Oh, okay.
Okay.
Ken?
Hello, Rebecca. Just one question.
Yes.
Do
Yes.
we need to remember like the section 19 or this one? Will the question I specifically tell you, this treatment need to be under 19A or something? Then we need to know what is it talking about.
Okay, so if let's say they were to test, right, they will tell you whether the company will be claiming under accelerated or not accelerated. Because your capital allowance or any qualifying capital expenditure can claim under section 19A or section 19, right? So if
Yeah.
let's say there's a computation on this, they will tell you whether it's section 19A or section 19, accelerated or not accelerated.
Okay, so we do not really need to commit to memory to remember lah. Just that if we know the treatment, how many number of years we'll do already.
Remember what?
I mean, do we need to remember like all the different section, like S19A, 1E, everything what it represent and all? Or can we just know like I know that low value asset we can do it within 1 year. So do we still need to remember the section numbers and
No need to
everything?
remember the section numbers,
Okay,
but
thank you.
need to know what is under the respective section.
Oh, so if they test like S19A1, I need to know what is S19A1.
Yeah.
Okay, understood. Thanks.
Okay, so after we have compute this table already, we know that okay, section 19A1 I have 17,500, then section 19A2 I have 10,000, section 19A10A I have 30,000. So my total amount of all these 17,000, 10,000 and 30,000 will go to my tax computation. 17,000, 10,000 and 30,000. Okay, so I will deduct against my adjusted profit before capital allowance. I will have the adjusted profit after capital allowance. So far, so good?
Rebecca?
Yes.
For the, let's say for example, for the table and chairs, right? For the cap at 30,000, do we need to see the breakdown of each tables and chairs, let's say? Like, maybe after we group a number of table and chairs, maybe the amount the closest we can get is like 29,000 instead of 30,000. So can we still claim 30,000?
No, it will be exact to the assets of each asset. So in this case, right, it didn't tell you the breakdown, assuming that they are all the same, right? It said $300 for each asset, right? So you will compute exactly 300 times 10 or 300 times 100 to get 30,000, right? So if in practice, if you are provided with a list of assets and they are all less than 5,000, and you have to choose and make sure that it falls below 30,000. So maybe you will not get exact 30,000.
Okay. So I only claim whatever it is.
Yes.
Not exceeding 30,000.
Not exceeding 30,000. Okay. This is for capital allowance under section 10A. Okay, but how about for I digress a bit. How about section 14N? If you exceeded the amount of qualifying capital expenditure, because your maximum can only claim 300, do you need to go and identify one by one all this? No need for section 14N. Okay, in practice. Okay?
No need?
No need. In practice, no need.
Oh, okay. Okay.
Okay. So then, okay, so I go back to my slide 9 again. After I compute my capital allowance, what is the next step I should compute?
Losses.
Losses, right? Losses brought forward. Okay, then I will add back my separate source income. Okay, whatever is taxable. Okay, so let's look at the losses. Okay, now I have losses under note 13. They have the prior year's losses, unutilized losses. You have a year end of 31st December 2018, 300,000, and year end 31st December 2019 of 40,000. On 31st July 2019, there's a substantial change. That is more than 50%, arising from a buyout of shares of the company by two sons from their father and mother. Okay, so this is unutilized. They say that there is a substantial change. So what is the first step that you do whether they can claim unutilized losses?
Shareholders test.
Okay, shareholding test. And what do I do in the shareholding test?
Find the 2 dates.
Okay, the two relevant dates, right? So the two relevant dates for the year, the unutilized losses for the year ended 31st December 2018. What is the relevant date that I use to utilize this loss in YA 2013?
First day of the year.
First day of the...
First Jan 2018. First day of the year in which the losses was incurred.
No, that one is carry back.
Should be
The last day of the year.
Day of the year.
31st December 2018, right?
Okay, so last day of the year where the unutilized losses arise, so it's 31st December 2018. Compare with which date?
1st January of the YA that we claim.
Okay, 1st January of the YA we claim is YA 2023, 1st January 2023. So they tell you 31st July 2019, there is a substantial change. So I'm comparing 31st December 2018 versus 1st January 2023. Is there a substantial change?
Yes.
Yes, because the 31st July 2019 fall between the two dates, right? So when it fall between the two dates means that your 1st January 2013 has a substantial change also. Am I right?
Yes.
So can I utilize?
Cannot.
Cannot utilize. Okay. Then how about year ended 31st December 2019? I have 40,000. Can I utilize it in YA 2023?
Can.
Okay, give me the relevant dates, please.
31st December 2019 to 1st January 2023, correct?
Okay, how you get 31st December 2019?
Because the losses is 2019.
Yeah, and then it will be the last day of the year. Yes.
Yeah.
And versus the
1st January YA.
Yes.
First
Okay.
Jan 2023.
Okay, so 31st December 2019 to 1st Jan 2023, is there a substantial change?
No.
No, because 31st July 2019, the substantial change happened before 31st December 2019. So there's no substantial change. If there's no substantial change, can I utilize the losses?
Yes.
Can.
Yes. So I can utilize the losses of 40,000. Okay. $40,000. Okay, so just now we say that okay. Yeah, I go back to just now that share screen for this one. Okay, so after that I have 40,000 here. I put it in my main tax computation. I less out, I have this amount. Okay? Okay, so far so good?
Yes.
Okay, so now we look at the tax com format again, slide 9. It says, what do I do next? I add back the separate source income. Okay, so just now I less out all the separate source income, right? Okay, be it taxable or not taxable, I less out first because I want to find out what is my trade source income. So all my separate source income, taxable or not taxable, I remove first. Okay, so now after I remove already, I need to see what is taxable, then I will add back. Okay, so just now the separate source income, I see. If you are looking at your, it will be good if you are looking at your profit and loss. So I don't want to switch over. I just see here. I left out just now. I left out dividend from DBS Bank of 30,000. Is this taxable?
No.
Exempt,
Why is it exempt?
because it's a dividend from the dividend local bank.
Dividend received from a local bank. Dividend received from a tax resident in Singapore is exempt under Section 13, right? One tier dividend. Okay, so if this tax exempt, what should I do? I put dividend 0. I don't claim. Okay, so how about the other one? Dividend from Indonesia. Is this taxable?
It's exempt also.
Okay, information in note 2 says that this dividend 8,000 is this no, not this one. Okay, note 1 says that income from which dividend was paid is subject to tax in Indonesia have a headline tax in Indonesia of 25%. So this 50,000, is this taxable?
No,
No. Why is it not taxable?
because the headline tax rate is already exceed the 15%.
And then
It's exempt.
Also taxed in the Indonesia.
It's
it is
exempt, right?
also taxed in Indonesia, and then
It's beneficial to the Singapore tax resident.
okay, assuming it is beneficial, and okay, so this is a
Foreign
Foreign
source income.
foreign
Exempt,
source
exempt, right?
dividend income. Okay, so foreign source dividend income, we will look at the 3 criteria under section 13(8), whether it is subject to tax in the foreign jurisdiction, and whether there is a headline tax of more than 15%, and whether it's beneficial. You got all 3 correct. Okay, so once we satisfy all these 3 criteria, do we tax this?
No.
No. So 15,000 is 0. And exempt under section 13(8). I put 0 here. Okay. Then next I go to my interest income from Australia. Interest income from Australia, there is a note 2. Note 2 says that out of the 18,000, only 8,000 was remitted, and interest income was subject to a withholding tax of 10% according to the Singapore-Australia Tax Treaty. So what do I do? How much do I tax? Interest income from Australia.
8,000
Remitted to
remitted.
Singapore.
Yeah.
Remitted.
8,000. 8,000. Remitted.
I think here there is one missing line.
Yeah. Singapore fixed deposit.
Yeah. Interest income. Oh, sorry.
Taxable under section. What's that?
The row number 14 is hidden. Maybe it's there. Row number 14.
Yeah. Correct. Thank you. Yes, interest from fixed deposit. So it is. Okay, so let's go to interest from fixed deposit first. Is this taxable? From Singapore fixed deposit, $2,000. Is this taxable?
Should not be.
Yes,
Yes. It is taxable?
to the company.
Yeah. So for company that is receiving Singapore interest income or overseas interest income, it is taxable. Only individual is not, okay? Singapore company receiving interest income in Singapore or overseas is taxable. All right, so this 2,000 is taxable under section 10(1)(d). Okay, so I will add back here, taxable 10(1)(d). Okay, how about interest from Australia? There is a note 2 saying that only 8,000 is remitted. Interest income is subject to withholding tax of 10% under the tax treaty.
Only the 8,000 is taxable.
Only the 8,000 is taxable. Okay, so I will add back the 8,000. How about my 10,000?
It will be taxable only when it will be remitted to Singapore.
Okay, it is only taxable. Very good. It is taxable only when it's remitted to Singapore in future years. Okay, so it will not be reflected here in my tax form for YA 2023. All right.
But why 8,000 even is taxable? Because there is a treaty and 10% withholding tax should have been deducted already by Australia Tax Department. So once it is deducted, why we need to pay it again since we have a DTA?
Yes, good question. So for this interest, right, we bring it to tax because all the income from all sources have to be subject to tax to arrive at the statutory income. Okay, then we will see that how much tax did we pay for this interest from Australia, and we compare with the tax that I have paid in Australia to compare which one is higher or lower. I will take the lower of it to claim under foreign tax credit. So in order for me to compute the Singapore tax payable attributable to the interest from Australia, I have to include it inside here. Then I can compute the Singapore tax payable. If I exclude this amount, I am not able to compute the Singapore tax payable because I exclude the amount. I have no Singapore tax payable here.
Okay.
Okay. So now I have this, I'm going to add 8,000 here. Okay, the next one is distribution from Singapore REITs of 7,000. There is a note 3 saying that distribution from Maple Tree Industrial REITs, Industrial Trust, okay, comprised of gross income distribution of 5,000, capital gain distribution of 1,000, and return of capital of 1,000. So out of the 7,000, 5,000 is gross income distribution. Is it taxable?
Yes.
Gross income distribution is taxable.
Yes.
Gross income. Okay. How about capital gain distribution?
No.
No. Okay. So how about return of capital?
No also.
No. Okay. So only 5,000 is taxable. So out of the 7,000, I have removed those everything. So I only bring those that need to tax here, 5,000. Okay. Then I have there another one, loss on disposal of investment property. Is this deductible?
It's a loss. No need.
No need.
It's a loss, no need to deduct. Is it?
Yeah.
Yes.
Why?
Huh?
Because
Loss.
it's a capital
Yes.
gain.
Yeah, because it's a disposal and then it is likely to be, it's an investment property likely to be capital gain, right? Unless the company says that, oh, this is actually, wow, the company is actually a property company, then they are disposing one of the property, and then that property is actually the stock in trade, then it is considered as deductible. But in usual case, loss of disposal on investment property is not deductible. Okay, so no adjustment since I already removed. I add back 15,000, so no adjustment. Okay.
Rebecca, for this one, just to make sure that maybe when we do the tax computation, we don't miss any item, right? Is it okay to put into your add section, but we put zero value?
Yeah, can.
Oh, okay.
Actually, the question says they need the itemized, right? Let me see. That's not the question. Did they say? Show itemized basis. or capital allowance and the relevant calculation. Yeah, you need to show, to make sure that you don't miss out anything, you need to show dividend, zero, dividend, not taxable, you put it zero. Okay? Can?
Okay, but we don't need to put the section, right? Like those exam under S13 one.
No need the section.
Okay.
Okay.
So is the cell F50 that's called statutory income, is it?
Yes.
Okay.
Okay, so I have a statutory income of 494,910. After statutory income, I less my donation. Just now, at which note we have a donation? In the profit and loss account, I have a donation, cash donation to Cancer Society in approved IPC, $1,000. Do you see it in the profit and loss?
Yes.
Okay, just below the accounting and audit fee, I have $1,000. So if this is approved IPC, how much do I get to deduct?
2.5 times of the donation.
Okay, 2.5 times. So 2.5 times 1,000 is 2,500. Okay, then I will arrive at 492,410. Okay, I don't have other losses. I don't have other current year losses, right? So I will have 492,410. Okay, if you look at your slide 9 again, your tax computation format, what is the next step that I should do?
Tapping.
Group relief.
Group relief. Is there group relief information in this question?
Yes.
Yes.
Yeah. Okay, so let's look at group relief. Okay, group relief is under note 14. The company holds 100% ordinary shareholding in Company A, and Company A holds 70% in ordinary shareholding in Company B. Okay, Company A has unabsorbed current year capital allowance of 10,000, and Company B has unabsorbed current year capital allowance of 50,000. All three companies, how come there's three companies? Oh, with the company. Okay, all three companies have the same accounting year end. So one of the criteria for group relief is three companies, right? Must have the same accounting year end, right? So then the company would like to make an election for group relief transfer if eligible. Okay, so assume that all these company A, B, as well as the company itself is all Singapore incorporated companies. Okay, can? So what is my first step that I should do? And satisfied
shareholding.
It is more than 75%.
Okay, shareholding that is more than 75%. So first step, I will see same accounting year end. Second step, I will see company all incorporated in Singapore. These are the two criteria. And the third step is 75%. Okay? Can? Three criteria. Same accounting year end, Singapore incorporated company, and 75% shareholding. But how about the loss item? What do I look at the loss item?
It must be current year.
Yes, it must be current year. Prior years can or not?
No.
No.
Cannot. Prior years cannot transfer under group relief. There's a slide saying that prior years, U, L, UCA, and UD is not allowed under group relief. Okay?
Rebecca, it didn't say that it's Singapore Incorporated though.
Yeah. So we assume in this case it is Singapore Incorporated. Can?
Okay.
In the exam itself, if they didn't state, we can assume, right?
Yeah. State your assumption there.
Okay.
Okay? So then if okay, so company hold 100% in company A. So company A has a 10,000. So can the 10,000 of the company A be transferred to the company?
Yes.
Yes.
Why?
Because it's more than 75%.
Okay. How about company B? Company A holds 70% in company B.
No.
No.
Less than 75%.
Less than 75%. How do you compute that it is less than 75%? Because I'm comparing company and company B.
100% times 70%.
Yes, 100% times 70%, this is less than 75%. So I cannot claim the 50,000 from company B. Okay? Okay?
Okay.
I only can claim 10,000. All right?
Okay.
So then in my tax computation, I will have a group relief of 10,000. Okay? After group relief, no more already, right? If you see the slide 9, the tax computation format, this amount of 482,410 will be the chargeable income. Okay? So after chargeable income, we have the partial tax exemption. Okay, applies to the chargeable income of 10,000 times 75%, 7,500. 50% of the next 190,000 is 95. I have more than 200 chargeable income, so the total amount that I can deduct is 102,500. And the chargeable income after tax exemption, partial tax exemption is 379,910. Okay, all in dollars. When I compute the tax at 17% for year of assessment 2023, the tax rate is 17%. Tax rate is always in cents, dollar and cents. Chargeable income is until dollar. Tax is always in cents, until dollar and cents, okay? Then next, just now we say that we have interest from Australia that's remitted to Singapore. We have $8,000, right? We have to compute the foreign tax credit. It says that it's subject to withholding tax in accordance with the Singapore-Australia Tax Treaty. Okay, so what is my working? I have a Singapore tax payable of foreign income. My formula is A over B times C. What is A?
Is the gross taxable foreign income?
Gross taxable foreign income, how much?
8,000.
8,000, because the amount remitted 8,000, right? Okay, then what is B?
Total taxable income.
Total taxable income, okay? Total taxable income is 494,910. So the total taxable income is here.
So this taxable income is the statutory income, is it?
Yes, the income from all sources before you less out the donation.
Oh, okay.
Okay, because if you see the foreign income is here, then I want to see a proportion of that foreign income that is subject to tax. I will use the foreign source, the foreign interest income over the total income. So I know the proportion that is attributable to this 8,000. Okay? Can? Then what is C? Multiply by C. What is C?
Singapore tax payable.
Singapore tax payable of 17% is 64,584.70. Okay, by using the 8,000 divided by the total income from all sources times the taxable income, I am able to find out how much of this 64,000 that I paid is attributable to this 8,000. Make sense?
Yes.
Okay, so I know that for my Singapore tax payable on the foreign income is 1,043.98. Okay, and in note 2 of the question, it says that there is a 10% withholding tax on the amount remitted, right? So I will have a 10% times 8,000 will be 800. And the double taxation relief allow for the lower of the foreign tax paid and the Singapore tax payable. So which one is lower? Foreign tax paid is lower. So I will take the 800 and put it in my tax computation. Then I have the amount of 63,784.70 cents. Okay, that's how you do a tax computation. You have one sheet of main com and the other sheet of all your workings. Then you can refer, it's easier. Okay? Yeah.
Regarding the group relief, I'm asking practically, the company B has 70%, right? The company A has 70% in company B. Why they do not have 75% from a practical point of view? They should have
Practical point of
75%,
view.
then they can claim 50%, 50,000 losses, right?
Yes.
Why do a company have 70%? They should have at least 75%. It's a group company.
Yeah. So tax is actually one of the concern, but not the main concern where the company, how the company structure. So sometimes the company structure could be, finance. Do I have sufficient money to buy 75% of the shareholding? Or it could be some commercial decision that I can only have 30% and the other party has 70%. So tax is just one part of it, but it may not be the main part of why the company will put the 70% instead of 75%. Because every country will have a different rule, right?
Yeah. Okay.
Okay.
Thank you.
Thank you. Any other question?
Can I ask in the
Sorry. No. So actually for FTC, foreign tax credit, we actually have to analyze whether it's a tax resident or not, right? Whether the company that is claiming the FTC is a tax resident, then we look into control and management, etc. first.
Yes. So if let's say the company is claiming, when you are doing a tax com, you always look at whether the company is a tax resident before you claim Section 13(8) exemption when you claim FTC. So there is one slide, I think, let me see the slide, which slide is that? There's a slide to say what is the difference between Singapore tax between Singapore and foreign company under the tax residence. Okay, I think it's slide slide 164. 164 will say what can a Singapore resident enjoy. So you are right, we need to know what is the whether the company is a resident or not in order to claim foreign tax credit. Okay?
Okay, thanks.
Mm.
In the exam, right, we have to do like all this in like the layout as per this, right, for like let's say for tax computation. So like these are the steps that we have to go through, like I have to write down.
This is not a formalized way of not of, I mean, if let's say you are looking at the workings, the workings is a way for you to tabulate your answers so that it's easier and more organized. So it's not like a must follow type of format. The must follow type of format is the slide 9. Because from the slide 9, then you will know that, okay, first step is always net profit before tax. Second step, less out non-trade source income. Okay, third step, add back non-deductible expenses. Okay, or less out those revenue capital items capitalized or further deduction. Then the next step will be less out capital allowance. And the next step will be so when I say non-deductible expenses also include lessing out the section 14N. After less out the section 14N, you will look at the tax capital allowance. So after the capital allowance, you look for any losses and donations. After you add back the donations will be after the dividend or the separate source. Then lastly, you will less out the good relief if there is any. And you find the chargeable income before exact amount, partial tax exemption, then the chargeable income after exemption, then the tax rate of 70% to be a tax payable, then you look at the foreign tax credit. So that is a typical trading tax computation. Okay? I will suggest that you all go through the case study 2 again to refresh your memory and go through those things that you are not sure. We can raise questions if let's say you have any to Tax Academy or CPF Australia. Okay?
Yeah. So where can we access to your your notes and also this answer sheet?
I think there's a portal,
The portal I tried, right, is even the last week notes also not available yet. So they say after the session has been concluded. So I don't know, is it this session concluded or until September then they're able to conclude this entire session?
Okay. Can the rest share where you all get the information from?
We collect from the CPA office. Kevin, you just go to CPA office, collect the hard copy.
You ask them for it. You need to tell them you want to collect a copy.
Yeah.
And when you're collecting it.
Even the answers is in the hard copy as well.
Yeah.
Oh,
Yes,
okay.
I have it. No, but I have it in the CPA, the portal, I download from there.
Can you give us the link?
It is available.
It's in the portal. If you go to the CPA, you log into my online learning, right? Then you press in where you do your registration for when you do the registration for all these sections under the column there to access. But I'm not able to screenshot right now to you guys because the Zoom here doesn't allow to screenshot. Because I screenshot the portal itself where they say there's all the answers and the slides are in there.
Yeah, we cannot give you the link because you need to log in and then access
Yeah.
it from your profile.
Yes.
But it's
Okay, thank-
available there, yeah.
Yeah. It's available there.
Yes,
Everything is soft copy in there.
If not, I think it's better that you email to CPA Australia or Tax Academy and ask them if they can email you a copy or ask them for the steps to access to the to the portal that you are
Yeah.
referring to. Yeah.
Okay, can I try? Thanks.
Did I miss any of your chat question?